call the meeting to order. Good morning, everyone. Hope you had a nice break during July, and we're back at it. So we have present myself, Vincent Zeri, Vice Chair Andrew Gardner will not be here for this meeting. We have Trustee Griardi, Trustee Lanza, Trustee Menon. Trustee Muyo will not be present. Trustee Oswald is present. Trustee Santos is present. Trustee Votto will not be present. So just noting that three of our trustees that are also members of the plan are not here. So it's unfortunate we might miss some of their input. I tried to reach out to them.
Count on the fire department.
All right, Dick. There you go. Way to represent. But I did ask for some of their input on some of the agenda items, which I'll share as we go along. We also have our CEO, Roberto Pena, our CIO, Prabhu Palani, and General Counsel, Jeff Rieger. So we're going to jump into closed session. We've got a couple items to cover there. We hope to come out by 9:30. For those of you in the audience, sit tight. We'll do our best to adhere to that time schedule. All right? Started. Nothing to report coming out of closed session. Let me cover the orders of the day. One is that item 3A, under old business, this item will be deferred, as the city auditor is not available today. And then on Sunshine, item 2B, discussion and action on asset allocation by Makita. I need a motion on that. Okay, do I have a second?
Second.
Okay, motion by trustee Santos, second by trustee Oswald. All in favor? Aye. Any opposed? Okay, great. So let's go to the consent calendar. Any items there that need to be pulled or discussed?
To approve the consent calendar.
Okay,
Mr. Chair, I was just gonna, if you allow me, I was gonna ask to pull items 1.4 D, E, and F.
okay. Any other items? So, Roberto, in terms of process, do we approve it, or do we pull those, cover them, and then approve?
Yeah, so you approve the consent item, and then those are pulled, and then they are approved in the second motion.
Got it.
Yes.
Okay. So I have a motion, Dick, to approve consent as is, having those removed.
Yes.
Do I have a second? Okay, second by trustee Oswald. All in favor?
Aye.
Aye. Any opposed? All right. And before we go on to that, I just want to bring your attention to item 1.4C. If you didn't have a chance, it's really literally only about a one-page article. Trustee Menon brought this to my attention, and I asked that this be put on the consent calendar under communication. Really interesting article. I think you would find it valuable. Take a moment to read it, please. 1.4D. Roberto.
Yes, I know, I just wanted to call to your attention, so this document is the revised schedule for the board and standing committee meetings list for the year, and I just wanted to make a note that the disability committee meeting on September 9th is stated in this document, September 9th, but right now, that day has not been finalized. There's a good chance, obviously the chair, trustee Santos, is not available, and the other member, Drew, trustee Lanza, is available different days, so we're trying to coordinate first, number one, if we're going to have a meeting, assuming that we have applications, and if we have a meeting, then we have to decide what the actual day is going to be. So I just wanted to make that point. In terms of 1.4 E, all I wanted to call to your attention is that usually your first meeting of the your meetings are always the first Thursday of the month, but I wanted to, we will certainly follow up in December, but wanted to let you know that the first meeting in January is not going to be on January 2nd. It will be January 9th. So I just want you to pay attention to that. Again, even though your usual first meeting is the first meeting of the first Thursday of the month, which happens to be January 2nd, your meeting will take place on January 9th. And lastly, on item 1.4F, I just wanted to, it's a letter, it's a memo explaining some changes that are happening related to retiree medical. And in a nutshell, it's a communications letting retirees know that there's going to be a switch from Blue Shield and Sutter to Anthem. And, that brings some challenges in terms of having to keep retirees posted, and we are going to be sending emails and postcards from ORS. But that process took place with the city and the group that worked on that process. This change was actually approved by the city council at one of their meetings in June, and that committee actually included retirees, and both of the retirees associations for Federated and for Police and Fire are already reaching out to the constituent to let them know the changes that are happening. And of course, as the memo indicates, ORS, our office, is going to be sending emails and postcards to the members and help them through this process when they have to make changes going from Blue Shield and Sutter to Anthem during open enrollment in October.
On an annual basis, how frequent does this change take place?
It's not frequent. I mean, they don't usually change. I think these particular situations came about because, I'm now Cheryl is here, so I don't know if she has any comments, but I believe that Blue Shield PPO is no longer a viable option due to the cost of the plan, and Sutter Health does not offer Medicare plans. So those were the two main reasons why they were transitioning to another provider. But this doesn't really happen every year.
So knowing that this doesn't happen every year, is there any advanced communication to members that this could be pending? So their first communication isn't, by the way, we've just changed plans.
They have been, I don't want to speak for the city, but I believe that because the group that was working on this change included the Retirees Association, the retirees have been kept apprised as to what's going on. In the meantime, even though we're going to be reaching out, our office is going to be reaching out by emails and postcards to the members, we have information in our website about it. So it's nothing new. It's just that we're going to provide more information as time goes along. But I believe there was an understanding that these changes were forthcoming. I know Cheryl sat down and she can speak more about it from the city standpoint.
Hi, Cheryl Parkman, Office of Employee Relations. I just wanted to confirm what Roberto just said. Both retiree associations are actually very integral to the RFP process for healthcare solutions. So they were well informed, and I think that our retirements benefit staff is good about communicating that stuff out to the retirees. So we believe that they have been informed throughout this process that it might change.
Okay, perfect, thank you.
Thank you, Cheryl.
Any other questions? Anything else? So I'm then looking for a motion to approve 1.4D, E, and F. Okay,
Second.
wow, I'm getting a theme here. Motion by trustee Santos, second by trustee Oswald. All in favor?
Aye.
Any opposed? Okay, motion carries. Thank you. Moving on to item 2. 2A, oral update from our CIO.
Thank you, Mr. Chairman. Welcome back. Hope you all had a great July. I want to start off by saying that, our fiscal year end results are in, and we are at about 4.2% for police and fire. I think it was 4.4% for Fed. And you may have seen some of our peer returns, which were actually significantly higher, especially the two large California plans came in at about preliminary numbers with 6.5% or so. We are actually working on the attribution, and we'll actually submit a detailed attribution to the board and, of course, to the investment committee. But real quick, it was a year of two halves. The first half of the fiscal year, the plan was down 4.9%. And from January to June, this plan was actually up 8.3%. So we had the worst fourth quarter when the plan actually did extremely well relative to peers. And then we had the best first quarter ever since the Great Depression, and we lag our peers. And by design, we've set up our plan in such a way that in a bull market this year to date, as of yesterday, the S&P was up 16%, phenomenal return. We are not designed to do well in those environments. And this may tie in well with our asset allocation discussion, which is going to follow. But I just wanted to give you those numbers, and more detailed attribution will follow. I'm happy to take any questions on that, or anything else. If not, I'd like to I'm hoping for a robust discussion on asset allocation. And just by way of background, this was discussed at the investment committee. Staff and Makita had actually shown the IC 8 or 9 different options, and the IC discussed, and we came back with 3 options. And I've actually added a 4th option, which I'll talk about when we actually go through the options. And I just want to know, let everyone know that, I mean, there's many ways we can go about this. We don't need to make a decision. We can stay where we are. We can choose one of those options, or the board can tell staff and Makita to go back and do additional work. So we are open to all of those options. So I'm happy to take any questions. If not, we can jump to
Mr. Chairman, I have a question.
Sure.
Of the options that we discussed at great length in the investment committee, does the staff and Makita have a recommendation for one of them?
Can we actually, can I hold off answering that till we get to the
Sure.
actual options? Okay. I don't want to jump ahead on
Yeah.
that, but we can
Any
talk.
questions related to just kind of the oral update part of the agenda? So let's then move on to the
Okay.
asset allocation.
So
I'll let
I'm-
you set the framework on that
thank
first,
you.
and then
Yeah.
we'll come back to you, Vikas, on that question.
Yeah. And I'm going to invite, Laura's already here.
So, yes.
And we
So
also
to be-
have Danny Sullivan, who the board is familiar with, as well as Max Gioliti. Okay, hopefully I didn't butcher his last name. So Max is the Chief Risk Officer for Veris, and very happy to have him here. As the board knows, hopefully I did inform the board, Ed Hoffman actually has moved on from Veris. Yesterday was his last day, and we now have Eileen Neal, who's a veteran of the industry, is going to be our primary relationship manager going forward. She could not be here today, but we are happy to have Max here, who's an expert on risk. And I'm actually going to have Max come up and sit here as well,
Sure.
because we are going to talk about risk, and Danny as well. So without further ado, maybe Laura can start. Thank you.
Sure, thank you. Good morning. I lost my voice earlier this week, so I have my bag of cough drops.
You can
So,
share the microphone on that side. I'm just talking to them, I'm sorry.
okay, sure. So I know that we've talked about asset allocation in the past with the board and that you've seen our framework. So I won't spend too much time on every slide. But we did talk over a period of a couple of the last investment committee meetings with the investment committee and have now narrowed down the asset allocation options that we're presenting and analyzing further. So as an introduction, these options are updated from what the investment committee has seen, and they were formed in collaboration with San Jose staff, and we're looking at a variety of risk levels. In our document on page 3, I know you've seen this chart before, page 3 and again on page 5, it is necessary to take more risk in the current market environment to achieve the same return relative to all of recent history, where you could have invested in pretty much any combination of stocks and bonds in, say, 1990 and achieved over an 8% expected return. It's now more difficult to get there. We base our asset allocation on mean variance optimization to start out. However, that's not the only thing we look at. We also look at scenario analysis, how portfolios would have actually performed in different historical market environments, and also stress test portfolios based on different forward-looking environments that we think might take place, because there are some, or actually many, drawbacks to mean variance optimization. Go ahead.
These are nominal returns, right? I mean, have real return expectations changed over time, or is it just inflation expectations have come down?
Real return expectations have also decreased over time, yes. And if you take a look at page 6 of this document, this is sort of the most important page in the review. So here we look at the current asset allocation policy and compare it to 4 different portfolios at different risk levels. So you can see that these other portfolios are named at the top of the page with their risk level. And then for purposes of comparison, you also see a 60-40 allocation on the far right. So increasing risk would require shifting some assets from low beta, which is primarily cash and short-term bonds, to growth assets, which is, as the name implies, things like equity and most private markets. So we've included the bottom of this page. You can see Makita's expected return and average annual return over the next 20 years, Makita's 10-year expected return, and then we've surveyed a group of other firms. I know that in our prior analysis, you've seen some of the ones that we look at the very last page of the document, BlackRock, Goldman Sachs, Morgan Stanley, GMO. We try to collect other capital market expectations just as a point of comparison. Then you see the standard deviation. So standard deviation is how you get that name of each portfolio at the top, the different risk levels. Currently, the portfolio, we estimate an 11% standard deviation. So we're looking at a range from 11.9 to 13% for these alternative potential options. Then we also wanted to include Verus's standard deviation because your risk reporting, your risk policy is based on Verus's numbers, not Makita's expectations. So the investment policy statement that you've adopted has a risk limit of 12% at the board level. So you can see the Verus standard deviations here. The very highest one is 10.1%. So all of these allocations have a risk level that's well within the risk policy limits in your investment policy statement. Then at the very bottom, we have the probability of each asset allocation achieving a 6.75% return over the next 20 years. And as you would expect, the more risk that you take, the higher we think the probability is of reaching that assumed rate of return.
So the standard deviation is Makita's expectation, and
So the first,
why are they so different? Because it looks like in some cases Verus is lower than you, in other cases they're higher.
so our primary expectations are 20-year expectations, and Verus looks at a shorter time period. So they have lower returns and also slightly lower risk. Another difference between our processes, and Danny and Max can correct me if I'm wrong here, but Makita tends to take a more conservative view of, say, private market assets. So if you look at an asset like private equity that's only valued every 3 months, and you put it in an Excel spreadsheet and you take the standard deviation, it's going to give you a pretty low standard deviation. We think that masks the fact that it's only valued every 3 months, really masks its true standard deviation. So we will sort of inflate that standard deviation up when we do our expectations. And then I'm sure there are many other, we each have our own models. I think Verus and Makita, neither of us manage assets, so I don't think we have an incentive to make anything look more or less attractive. But we each have developed our own models over our firm's histories.
The one comment I'd make here is, this says Verus standard deviation, but this is MSCI Bar 1 risk system standard deviation. So these aren't based on our capital market assumptions. They're the strategy in MSCI's Bar 1 system.
And just to clarify, when the board adopted a standard deviation for the plan, we used the bar numbers.
That's correct.
So we now have throughout the rest of the document a variety of different types of analysis looking at these alternative portfolios. A couple of differences I'd point out, just looking still at this slide 6, is that in general, we're just shifting assets from low beta to growth in order to get a higher return and also risk level. The 13% risk alternative option on the far right does also shift out of commodities and moves foreign bonds down 1% to also shift those assets to growth as well to get that higher expected return. Also, 3 out of the 4 of these alternative policies take hedge funds down from 7% to 5%. And this is something that we collaborated with staff on and believe that a more optimal level of hedge funds in the portfolio is closer to 5%. In terms of the additional pages, we do have a peer comparison on page 8. These peer comparisons are sort of notoriously unreliable because they're based on self-reported data. So whereas we might report private debt as alternatives, someone else might report private debt as fixed income. So one thing you'll notice is that the median percentages do not add to 100%. So if we sort of gross them up based on what they add to, we see a trend that that your plan, the police and fire plan, is below median when it comes to U.S. equity relative to peers, pretty far above median when it comes to fixed income or those low beta assets, and also a bit above median when it comes to alternatives, but not to quite the same degree. So those are sort of just the observations that we'd make relative to peers in this public defined benefit greater than $1 billion universe. Looking at more mean variance optimization based analysis on page 9, you can see the worst case scenario returns and also the probability of experiencing negative returns. So there's sort of a commensurate balance here in that the higher risk options do have a higher probability of experiencing a negative return. They also have worst case scenario returns in crash type environments, but the higher risk options also have a higher probability of achieving the assumed rate of return, which is not a huge difference if you look at the 1 year. The current allocation has about a 52% chance. The highest risk that we're looking at has a 54.5% chance of achieving the assumed rate. But if you look over a 20-year period, that compounds. So you can see that the 20-year current portfolio has about a 61% chance of achieving the expected rate of return, whereas it goes up to 69.4% with the higher risk option. I'm going to skip over some of these charts that just show the same things that we just talked about to page 13. So here we get into non-mean variance optimization based analysis. So these numbers are not based on Makita's expectations, but are based on actual asset class returns in different market environments. Of course, they're not using your actual managers in your portfolio. We'd hope that some of your active managers in particular would be more defensive than the broad asset class would be. But these are based on broad asset class returns for these different allocations in different stress market environments. One thing that I think is interesting is that the 13% risk, or the highest risk option that you're looking at, has a global financial crisis return, or would have had a return of down 26%. It's exactly the same as the 60-40 allocation. A lot of market environments, sort of a really plain vanilla 60-40 looks better in different stress market environments, but really even the highest risk option that we're considering right now would be expected to have the same negative return. A lot of that is because your portfolio would be more diversified at this 13% risk level. Having private assets that aren't as volatile would help protect relative to a purely public markets allocation. We also look at positive market scenarios. When we first started putting together our asset allocation reviews, we only showed the negative side, and some of us who were talking to clients regularly said, can we maybe also balance that with some recovery scenarios? Because as we know, the most important thing, if we do take on more risk, is to stick with that risk level, or even raise it if we do have a huge crash, so that the portfolio is actually able to recover over time. And you can see these positive market scenarios on page 14, and the results are as we would expect, that a higher risk level would be expected to recover better or have a higher return in a positive market environment. We do look at stress testing on pages 15 and 16, and so these are various forward-looking scenarios that are not based on our mean variance expectations. So when we look at scenarios like rates rising, you can see that the higher risk option actually would look better in a rising rate environment, and mainly this is because it would have less fixed income in sort of the higher risk levels. Your primary risk factors are still going to be a huge equity market decline and a commensurate widening of credit spreads. So you can see in an environment where U.S. equities decline 40%, we'd estimate that the current portfolio would be down about 22%. The 13% risk portfolio would be down 26%, with the other portfolios falling in between.
Mr. Chairman, can I ask a question here?
Sure.
When you assume the U.S. equities decline by 40%, what's the corresponding assumption for non-U.S. equities?
I can tell you exactly. We've got the assumptions in the back. So when U.S. equities are down 40%, we would expect that global equities would be down 43%, and that developed market equities would be down also 43%, emerging down 49%. So you have obviously many other very negative asset classes along with U.S. equity declining.
Okay. Thank you.
All right, then we have economic regime management, which I think we've discussed before with the board. That starts on page 17. So what we found is that the actual level of inflation rates doesn't make all that much of an impact on your portfolio. What matters is how much of that was expected and sort of already built into the market environment and how much of that was unexpected. And so we look at surprises on things like interest rates, inflation, a growth surprise, which would be a good thing, or a systemic risk surprise, which would be sort of like a global financial crisis-like environment. You can see here that the higher risk portfolios are more exposed to these different surprises that would take place in the market environment. So in summary, I don't believe that we are recommending any particular change. I think we wouldn't have included an asset allocation in here if we didn't think you could make a case for it. In general, we just wanted to show you how we would construct portfolios at different risk levels, since that's a topic of a conversation for the board.
Thank you, Laura. Mr. Chairman, if we can go back to slide 6, I have a few comments.
Sure.
So one of the things that I have struggled with throughout this process, and I'm not going to avoid answering Trustee Oswald's question, I am going to give an answer in my own way, is what is the right level of risk, right? And that really dictates what the asset allocation should be. And this is something, the risk analysis predated me by a little bit. So I've been trying to get an answer on how did we come up with this risk number? What does 12% risk mean? What do these ranges mean? And I was fortunate to have a conversation with Ed before he left Veris. And of course, we just had a conversation with Max and Danny, and I'm going to ask them to chime in here as well. And Max is very eloquent about risk, and you can see that it's his passion talking about risk numbers. But we've always thought of risk as, what is the shock to the system, especially on the downside, the drawdown to the system? What can our sponsor take, right? And we have a very broad range here. So Veris came up with this 8 to 12% number between, if I'm not mistaken, 8 to 10 is still within the CIO's purview, and 10 to 11 or so is the IC, and 10 to 12, and anything over the 12 should be discussed at the board level. So even at the 12% level, and I'm going to have Max talk about this, it's not that 12% is a bad number. There's no right or wrong answer here, right? We have to look at this along with, Chiron's analysis and the shock to the system, and if there's a drawdown, how much can we stomach this? And what should that be? Is there a 1 in 20 probability that we lose 300 million? Is there a 1 in 50, 1 in 100, and so on? So the answer to Trustee Oswald's question goes back to how much risk can we take and how much risk can we stomach? And the asset allocation will then be based on that risk number. And I'm going to actually have Max and Danny talk a little bit about those numbers. Then I'm going to come back and make some comments, and then, I'm hoping for a good discussion on this.
And before you do it, since we're on this particular page, one thing I want to point out to the trustees from our investment policy is that if you were to take a piece of paper and cover up the top half of this page, that's truly what we're supposed to be doing. And in essence, kind of a blind look at risk and expected returns without looking at what the asset allocation is, what the underlying asset class is. Would you mind commenting on why we're taking it this step versus that approach?
Yeah, go ahead, Lynn.
I'd mentioned, I know that the formal asset allocation review is designed to look at risk first. I think this is sort of an update. You did a very large, intensive asset allocation review last year to get to where we are now. However, we do want to look at asset allocation every year and sort of either reaffirm where we are or look at other options. So I would say that when we start a brand new, every few year process of really taking a fresh look and thinking about making very large changes, I do think it makes sense to start with risk. I would look at this as more of an update of potentially tweaking around where we already are.
Perfect, thank you. Okay.
Danny, Max, you want to talk a little
Sure.
bit about the ranges and those numbers? And then-
Yeah, so just as a reminder of how we got to this 12 number of the risk limit for the board. So we had the board retreat, which was, I believe, over a year ago now, and we tried to work with the board to come up with their risk tolerance, right? And so we sat down and we said, what's important to the board? And we went through a list of all these different types of metrics, and the board said, funding ratios are kind of the number one priority. Contributions, sponsor contributions are very important. Interest costs on UAL is important. Volatility of the investment portfolio is important. And so we continued going down and listed by priority which ones were important. And then we went through different scenarios of what if we saw a 15% drawdown in the investment portfolio? What would happen to your funding ratio? What if we saw a 20% drawdown? What if we saw a 25% drawdown? And so we looked at all these different scenarios, and what we saw was at the 25% level, we started to see quite a bit of discomfort from the board and from others. And so we said, okay, what sort of investment portfolio would cause you to potentially incur a 25% drawdown? Any investment portfolio can cause you to get that drawdown if you have a bad enough scenario, but how likely would it be if we had a 12% volatility or 12% risk portfolio, how likely would it be to have a 25% drawdown? We ran some analysis and we said there's basically a 1 in 100 year chance of something like this happening. And then we thought about a 1 in 20 year chance, a 1 in 10 year chance, and basically what we said is the risk limits, which define kind of the board's risk tolerance, the board did not want to exceed certain levels of funding ratios and sponsor contributions at such a level that the 1 in 100 year probability is what we set the tolerance at. And that's always open for discussion, right? If the board wants to change that or change their risk tolerance, we can always have that discussion. But that's how that was initially set. That 12% number goes back to a risk limit of a 60% potential funding ratio. So we do not want the plan to drop below that. We do not want sponsor contributions to exceed $335 million a year. So those are the hard numbers that are associated with that tolerance. And that's how we got to the 12%. Do you want to add anything to that?
Before we
Yeah.
go ahead, I want to ask one question. I have this, the limits from last year's study in front of me, and I just want to clarify something. You said that, I think the limit that I see here is $370 million in total contributions, not $335 million. That's on page 14.
That was total contributions.
Okay.
Yeah, so I think you're looking at like the board retreat, this is the recap
Yeah.
of the retreat. And
Yeah.
so what we decided, what we presented at the retreat was total contributions, and then what we decided to put in the risk policy was the sponsor contribution amount.
Okay.
Yeah.
Just wanted to make sure that we were clear on your statement. When you refer to that limit, you just strictly referring to the police and fire plan.
That is correct.
Okay, I just wanted to make that point clear
Yeah.
for the public and obviously for the council member, that number was just about police and fire.
Correct.
Yes. When I said that number, I'm referring to the contribution by the plan sponsor. Yes, thank you.
Thank you for letting me be here today. I want to make a couple general comments on, what I've heard on the risk, right? And then wait until, the actual numbers are discussed, so I don't give a whole speech now. On the difference between, a provider A and provider B risk models, it is very common to have, respectable providers have different risk models. So the fact that one is different from the other is not necessarily, an issue. They usually trend together, so you see that they go up in the same direction and they go down in the same direction. Most of the time, the difference comes to the look-back period, right? So if you look a very long time period, you get a different number from a very short time period. So that's something to to keep in mind. The other thing that stands out to me, and I think it's the most important consideration in my opinion, is that it is important to develop an intuition for these numbers, right? The last thing I want is for board members to think that you need to have a secret room with specialized people computing numbers that only they understand. I think it's actually the complete opposite. So when you look at that, page 6, this page 6, this has a lot of information here, right? And it's very hard to digest, and it looks like there's a million levers to pull, right? And you only have 2 hands, really. So, a useful intuition tool that I find is to just look at say, equities and cash from 50-50 or 0-100 to 100-0, and then develop an intuition as to what happens there. Because I think that is a big driver of all the other answers, right? And so once you have that, then you can start, making refinements around that. But it's important to develop that intuition, right? Otherwise, an asset-by-asset analysis is going to be clouded in correlations and this and that, and so that's how I would look at it. And so, I would make my decision on the asset allocation based on that. Now, whether it has to be higher or lower, well, there is this thing called peer risk, right? And, we all hate of thinking, well, I'm going to worry about what my neighbor does when I do my decisions. But it is a very real risk. It is a risk that, has, kills, really, right? Last thing you want is to have somebody start mentioning all the other plans around you that are doing better just because they're taking more risk, which has happened to be a good strategy in retrospect, right? So I'm not here to tell you whether you should take more risk or less risk. I want to make sure that you have a good way to calibrate what you're doing. And so I think the process you've been going through and so on is very good background for that. And so, something that stands out is that there is this 60-40 portfolio out there that's everybody's benchmark in some sense. And so taking risk relative to that is one way to take risk. And you can have less risk than that portfolio, and you're actually making an active bet. You're saying, everybody has a 60-40 roughly, but I'm going to take less risk than that because I think, I'm going to outperform it, right? So there is a risk you're taking. So you can take risk by not taking risk. And so, if anything, I would say, let's recognize that the peer portfolio matters, right? Whether you're in the 90-something or in the 20-something percentile, right? If that matters, let's keep that in consideration. And also keep in mind that there is a free risk, so to speak, which is going closer to the 60-40, right? Because you'll reduce your peer risk by doing that. And so it's been a tricky 10 years for risk managers because everybody, said, oh, the world is going to end 10 years ago. And a lot of the entities that were very prudent about risk, ended up underperforming, right? And so you can pick any random day from the last 10 years and say, are these people doing the right thing? And you could think, yes, they are, but in the end, they underperform, right? So there's a little bit of luck here too. So it's not very easy to do. And so my suggestion is develop that intuition, right? And that's, I'll have further comments as things arise, but I'll be happy to take questions too.
Let me piggyback on that. I don't know that all of you can tie that back to stuff we've said for the last 3 or 4 years. But what was just said is really prescient and really brilliant. Let me rephrase it if you'll allow me. And we said this before. We have many ways to come at things from 2 directions. Oh, I do it top down, I do it bottom up. Oh, I'll grade on a curve, oh, I'll grade absolute. Oh, I'll look at it at 100,000 feet, I'll look at it at 0 feet. And what we just heard was something we've talked about off and on. There is a way to get at risk in an absolute sense. We can say, well, what's going to happen in a downturn? And San Jose says, oh my God, that'll kill us. Okay, let's not touch that third rail. But as the gentleman just pointed out, there's another way to come at risk that we've talked about, and that's using the wisdom of crowds. And that's by looking at our peer group. And we talked about that just early this morning, Vince, right? We dialed down our risk to be less risky than just about any other plan. Now, it may turn out that was the wrong thing to do because we didn't quite factor in that San Jose is a strong city, only that our actuary had told us that we're very sensitive to risk. Why is the wisdom of crowds important? Because if you're listening carefully to what the gentleman just said, the way we are forecasting risk in an absolute sense is based on historical data. God never said the future would be like the past. Man says the future will be like the past. It is believed, and we have a hypothesis in place here at this board, that the crowd can see the future, right? If you are familiar with the theory of the wisdom of crowds, the pension plans across California meet the 5 key criteria to be considered a wise crowd. You can look it up on Wikipedia if you know. I just looked it up again to make sure I had it right. I believe the pension plans in California can predict the future. I believe people collectively can predict the future. I will give you a concrete example of this. When we go to model inflation, we model it based on history. I think that's incorrect. I think the advent of computers and the advent of larger government systems has fundamentally altered the way inflation works. And I do not believe that inflation in the future will match inflation the way it worked, at least not, say, from the Great Depression through to 2010, or say to 2000. I believe people see that. I believe the wisdom of the crowds, the pension funds see that. And so it's very, very important, and I think the gentleman just said this, to look at it in an absolute sense, to use mechanics and math and so on and history to calibrate ourselves. It is also very, very important to look across our peer group and say, what are they doing? Unfortunately, we seem to be the only people doing this, and so we knocked our discount rate back, and everybody followed us. It is true, if you've read the book, The Wisdom of Crowds, that that is often the case, that the crowd kind of knows it needs to do something, but it doesn't move until there's a first mover. And then everybody kind of says, yeah, we kind of knew that, we kind of followed. So our hope has been that bottoms up, tops down, historical, look at it mechanically, right? And then bottoms up, sort of what is the crowd saying as we go to the conferences and talk to other pension plans, that those two things would meet somewhere in the middle. And they would both sort of calibrate to more or less the same thing, maybe with the wisdom of crowds saying, yeah, dial it down just a little bit because inflation's not going to be what it was historically. So I'm pointing this out ahead of Prabhu to remind ourselves, as the gentleman just said, and he's absolutely right, we could do all the mechanics in the world, right? But that is based on our belief that the future will resemble the past. I don't believe it will. I think the crowd doesn't believe it will, and we should also listen to the crowd, as unruly and noisy as it might be.
May I, Mr. Chairman?
Sure.
Something a lot less interesting than what Trustee Lanza said, but I think it's important for the discussion. So if Veris had said, done this analysis and said, we can operate within this 8 to 12% range, it's a pretty broad range. Why are the options presented today are still within 9 to 10? They're about 8.6 to 10.1 and not 12%, and that's an important question. The reason we haven't done 12 and we've stuck to 10 is that we are in a low volatility environment, right? And vol has been very low for the last few years. Will it continue that way? Maybe it will, don't know. But as you all know, it can jump drastically higher, right? In a moment's notice, or without notice actually. And particularly on the downside. So if there is a drawdown, and we are operating at the 12% number, which will be the high end, we could see that vol has jumped to 14% and it's all negative. So it's something to keep in mind. You'll also notice—
And there are historical precedents
yes,
for that. Yeah.
absolutely.
Yeah.
And you'll notice, back to Chair Sunzeri's point, why are we looking at not just the risk, but also the allocation? If you look at even at the 10% Veris standard deviation, the risk level, the equity allocation is as high as 68%. It's much higher than a 60-40. So you can only imagine what a 12% allocation would do to equity allocation. So having said that, now I'm going to go back to answering Trustee Oswald's question, at least indirectly and in some part. I would say at a minimum, so when we ran this analysis last year, and we came up with the current allocation, the projected risk was higher than it was today. And it's now dropped to below 9%, 8.6% or so. So at a minimum, one of the alternatives I'd urge the board to consider is at least going back to that 9.5 range, which is here, column 2, which is the 11.9% risk number, which marginally increases your equity allocation and drops the low beta allocation. I would certainly suggest that at a minimum. There's, of course, other options that you can consider. I would also keep in mind, and the valuation of the current market, right? Markets are not cheap. They're not 1999 when the PE was, of the S&P was close to 40. But we've all said this for 3-4 years, that markets are expensive. And whether it's by engineering, whether it's by monetary policy tools, I mean, you can come up with any number of explanations. The market rally has continued. Now it simply seems like margin expansion at this point to me, rather than anything else, and using monetary policy. But we are entering an election year, and I think the current administration will use every tool in the book to try to continue to keep this market up. And and people can disagree with me, and maybe the bull market will continue. There's certainly that possibility exists, right? So that's something to keep in mind. As we think about risk, there are times when you should dramatically increase risk. There are times when you should marginally increase risk. Or you can give yourself the option of increasing risk in stages tied with market valuation. So these are some of the options that I would urge the board to consider.
Can I ask, so is there any data on predicted risk versus realized risk for our portfolio historically?
I would actually I'll let Max answer that question, and then I'll go back to our portfolio.
In general, you have an example out there of the risk parity funds that have a targeted 10 vol and are all realizing, or some of them are realizing less than that. So it's a general phenomenon that the forward-looking vol these days is higher than the realized vol. Then you've been following the portfolio more closely.
Yeah, so I guess 2 comments there. One would be, we could actually run an analysis to see what we said in terms of
Yeah.
forecasted versus what Makita's report actually shows in terms of realized. I think that would be useful, and we could run that. The other thing, we had a chart in our deck that just showed what's happened to volatility through time, and there's just been a consistent lowering of the risk through time, just over the last couple of years, but it's been over an entire decade. Really.
Sure.
Yeah, I would add that it's a very hard number to predict,
Yeah.
but if you just look at the last 2 years,
Yeah.
the realized risk has been lower than forecasted risk.
Right.
I don't know if that'll continue or not.
Yeah.
And you find, particularly when you look at these funds designed to run at a certain risk level, that they're not boosted all the way up. They're still kept lower, even though the realized is measuring less than because it's supposed to be a forward-looking estimate, right? Versus, what actually happened.
Gio?
I know we've had these discussions in investment committee. I think the question is, what are you proposing at this point, whether it's a process or whether it's a very distinct recommendation to select something or to tweak one of these columns? But I think in investment committee, there's been some agreement that we need to consider some of these options.
Yeah, I don't have a concrete recommendation. Like I said earlier, I would say we should at least go back to the risk level that we had when we did this exercise last year, which would mean column 2, going back to the risk level at if you use the Makita model, it's 12%. The Veris model is 9.4%, which will marginally increase the equity exposure. But again, I would tie this back. And the reason I am cautious is because of my view on valuation, but you can all disagree with me on that. But I would go back to, once again, valuation is important, but also what is our sponsor strength? How much risk can we take? Are we taking, within this range of 8 to 12, are we taking too less as opposed to too much within that range? And that should really dictate the column that we pick.
Can you, Danny, go back and talk about that risk number over time frame? Because we had talked about a short-term risk number, an intermediate and longer term. And it seems like we're getting hung up on what this risk number is today versus the duration of time frame that we are looking at that risk.
Yeah, so the volatility number that we're looking at, the out of bar one or the various standard deviation number here, is intended to be a long-term forecast. So it is that, it's intended to be an 8 to 10 year time frame. So while it may look, it may be down 50 or 60 basis points from where it was last year, all that's doing really is implying that we're seeing lower volatility in markets today. Does that kind of answer the question?
But in any single year, and I think what I was hearing from you, Prabhu, earlier, is that we could dial up the risk, volatility could pick up, and now we're beyond the risk limit. But that's on a single year basis, right? That's not over a 10 or 20-year basis.
Yeah, so the longer-term model, which is the one that we proposed using, and it's the one we're presenting here, is intended to react slowly to
Correct.
changing environments. So if the VIX, right, which is the short-term volatility that they use for option pricing, if that spikes tomorrow, the expected volatility of your portfolio is not going to spike like that. It's gonna be much more slower moving. So if it spikes, volatility in markets spike, and it's sustained for like several months or years, then we'll start seeing upticks. But it's intended to be slow moving. You don't want to react to month to month or week to week movements in volatility. You want to be a long-term, the board has set a strategy to be a very long-term investment portfolio, and so decisions should be made over the long-term period.
So when I look at our forecasts over the 8+ years I've been on this board, I have the benefit of having seen not just one, but two consultants show us expected returns over a 3 to 5, over a 10-year time frame, expected risk, and as our former trustee Evnine pointed out, they're just forecasts. And we haven't achieved any of them. So I don't want to say I take this with a grain of salt, but I do want to say in the real world, we haven't achieved any of those with following many of the asset allocation recommendations that have been presented to us. Then when I look at comments that were made, Prabhu, regarding our performance in the fourth quarter and the first quarter, we're set up for a conundrum, as you pointed out. Fourth quarter, particularly December, one of the worst months that we've had since the Great Depression. And what did our plan do? On a peer basis, we moved to the top 10%. Immediately followed by a Q1, which was very strong, which we didn't participate in as much, and we moved to the bottom of our peer group. I think the desire was to reduce risk because we understand the leverage ratio of our plan from an actuarial perspective. But I don't think the intention was for us to either be in the top 10% or the bottom 90. And what I want to know is, how do we get near the middle? How do we structure a portfolio in which of these asset allocation helps us take less risk than our peers? And immediately, having less than 60% in equity is one way of doing that, but doesn't put us in the bottom 90 percentile. We've all been holding our breath for 4 or 5 years now. And Prabhu, I know you've only been here for a year. Brian, you've been an investment officer in the audience. I mean, you've been on staff for at least 3 years. We've been hearing this. We've been holding our breath. The market valuation's rich. A pullback is coming. We have a Fed that's manipulating this economy significantly and holding this at bay. And maybe when it comes, it's going to be a doozy, as they say. But we're missing a lot of opportunity while we're waiting for that. And so I guess back to my pointed question is, where do we drift that gives us closer to that middle of the road approach where we're taking less risk, but we're not the worst performing plan out there?
Well, the only thing I can say, Mr. Chairman, is that as Trustee Lanza pointed out, the wisdom of the crowds, right? And California pension plans have done better than us, and maybe there's merit to that, to looking at some of the plans and their allocations, keeping in mind that we are an outlier in terms of the impact on the sponsor. The one other thing I would add, just for the long run, we are a long-term plan. There's certainly the risk, as Max pointed out and Trustee Lanza pointed out, is the peer risk, right? We are in the bottom decile of our peers longer term. The other thing to keep in mind, we are very sensitive to our sponsor. We have been. But we also have to think about our beneficiaries. And if we think our beneficiaries are our most important constituent, then we have to say, longer term, if we do increase risk, yes, it's going to impact our sponsor. And there's a 1 in 100 chance, as Danny pointed out, that there could be some pain inflicted on the sponsor. But are we willing to take that chance to inflict a little bit of pain, which may or may not happen, but longer term, which will serve our beneficiaries better? And if we really think that our beneficiaries are a number one constituent, most important stakeholder out there, then longer term, we should probably be taking a little bit more risk, because that's the only way we're going to generate better returns in the long run. So I would also keep that in mind as we discuss these options.
So I want to point out something. If we can move to slide 9. This is what's so interesting to me when we start to think about risk. And if we simply look at the worst-case scenario 1 year that's on this chart, the current allocation shows a negative return of 15.3, and if we had the highest risk of 13, it's negative 17.9. We would have had 2.6% underperformance in that one worst-case scenario. And you just pointed out to us earlier, when you gave us our preliminary numbers, that we may have underperformed our peers by over 2% in a decent environment. So how far do we go to protect downside when year by year by year, we are having very weak performance?
The one thing, sorry,
I'm sorry?
no, please, I didn't realize.
So, obviously, I've been an advocate of reducing risk in our plan, predominantly because of the fact that we are very leveraged, because we want to have a plan that is continuing to grow in funding status for our members. But I still fear that we've taken it too far.
Mr.
And
Chairman.
now the dilemma continues to be, okay, well, let's move back. But we're waiting for that opportunity to move back, and for 4 or 5 years, we haven't gotten that. So first, Councilmember Foley, then
Yeah, sure.
Trustee Oswald.
I'd actually just like to weigh in as the sponsor representative and the risk-averse philosophy and the grand jury report, which I know we're going to be talking about later on. But every time, if we take a greater risk and the risk doesn't pay off, the sponsor then must pull more funds out of the general funds. We all know that, but I'm saying that to emphasize the point. Every time, having just passed the budget, every time we have to pull more funds out of the general fund, that means less funds to hire police and fire to keep our city safe and our staff, and pay staff what we need to retain them. So while I appreciate the arguments about risk and changing the level of risk, I would caution from the sponsor's point of view that the city cannot sustain much more in unfunded liability. So we need to figure that part out. I just wanted to emphasize that.
Okay,
Thank
so,
you.
but let me continue with that thread of thinking, because what I'm hearing from our meetings with City Council, from the mayor's budget message, from the grand jury report, is this plan is underperforming its peers and should have higher returns
Right.
than their peers. It's due to our decision to de-risk the plan. So I guess I'm not clear on which is it. Is it, okay, we don't want you to take risks because we can't have a greater unfunded liability, but we need better returns. They're tied to one another.
I hear you, and I don't disagree with you either. There's other recommendations in the grand jury report that need to be addressed that could offset the unfunded liability or the cost. The two pension boards, I know we're gonna get into a lot more discussion about that, and I look forward to that, but I don't disagree with you. How you balance it, it's a catch-22. It really is. I'm gonna look up the crowd. Wisdom of crowd, because that's.
Trustee Oswald.
I
Okay.
tend not to follow the crowd, so, okay.
So
But I appreciate that.
I have a few thoughts on what Councilman Foley said, but I'll wait on those for a few minutes. I have just a few specific things to say about how we got the predicament that you outlined. You know, you took a little less risk, but you ended up in the bottom of the pile. You know, as you know, we produce a dashboard that's included in this package. That dashboard shows that our risk, the portfolio risk, is 8.1%, and the peers, assuming the peers are correctly specified, is 10.2. So we've taken 25% less risk. And if we, you know, do some simple math, if you take 2% less risk and you run the portfolio at, say, a Sharpe ratio of 0.4, that's a full 80 basis points, which is a big number for a portfolio of $3.5 billion. So I think that explains much of it. The other thing I would say, in terms of asking Max for his input, is I think you mentioned some peer risk as well. Where are we relative to peers in terms of the risk of the current portfolio?
Well, you know, obviously the definition of what the peer is, you know, is important, but if you look at the 60-40, right, I would say that's always a peer, and you can see that you are below in risk, right? And so my point earlier was that just because you're taking less risk doesn't mean that you're not taking more risk. You're taking less market risk, but you're increasing your peer risk. And the peer risk is not usually measured in these reports, right? But it is real out there. And so you are under that level, right? Now, from hearing, you know, the comment just made, right, there is a certain push in the other direction too of saying, well, you know, we can't take so much risk. So I can't actually tell you if having less risk is the right thing for you, right? I will be just at peace when I see that, you know, everybody says, okay, this is what's really happening, and that's our decision.
Okay.
And so that's, you know, but I would definitely say being, you know, it shouldn't be a hard thing to measure, right? The 60-40 is doing this, and we're doing this, and so that's what everybody else is doing, roughly speaking.
Right. And I think I want to just open a little can of worms, and this requires a separate discussion, probably with the mayor and Councilmember Foley and her colleagues. But I'm going to say something a little bit provocative, and I'd say that as a group, you know, we wondered about the descent in returns. But sometimes the descent in returns doesn't just have a negative connotation. A continuously declining set of returns for asset classes also is an opportunity. A city that has a AA rating, as long as it has borrowing capacity, could simply borrow the unfunded liability and save itself about 3.5%, between 3 and 3.5%. That's the difference between what the city pays the plan for the so-called interest cost. Because remember, the unfunded liability, we charge the city an interest cost, which is charged at 6.75%. With a AA rating, a taxable bond issued by the city would sell for about 3.3%. These are the market. So there's that silver lining in these declining rates. And this doesn't require any complicated math, doesn't require any finance background. So if you can save between 3 and 3.5% on a unfunded liability that is a couple of $2 billion in the hole, that's $60 million. And that's what this city has been persistently shortchanging the community at large by simply, and I can see the issues, you know, we all as elected officials don't want to burden, quote, the taxpayers with debt, but the rational thing, the smart thing, would be actually to simply fund the liability, take the plan to fully fund it, and save in the long run at least $60 to $70 million in perpetuity.
You're talking about the pension obligation bonds.
Yeah.
That would be the title of
That's
the
right. That's
bond
right.
issue.
And as from what I've read of the city charter, as long as the total obligations are under a certain percentage in terms of the taxable real estate base, and I'm not an expert on bond issuance, but to me it seems like and then if we get to 100% funded, we would actually, all of this discussion would be moot. We could fire all the managers, we could fire all the consultants, and we would be in balance. And we would save $60 million, $70 million in perpetuity.
Well, I think that may be a very good way to go, but I think you and Vince are both dancing around the same core fundamental thing. So the city says to us, and Peru correctly here is, man, volatility kills me. So we go out and say, all right, well, we have to really give you a certain return. So we go out to them, what can you get a certain return now, 1%, 2%? What can you lock? If I told you, give me a return that's absolutely guaranteed, what, 1, 2, 3%? It's pretty low now, right?
2% on the
2%.
10-year treasury.
Okay, and the city says, well, crap, that'll bankrupt me. Can't do that, so we start turning up the risk knob, right? To get it up to 5, 6, 7%. The problem with 5, 6, 7% is some years it's 10, and some years it's 2, right? And we have said, I think correctly, due to that leverage we've got, let's not quite turn that risk knob up as high as everybody else. Look, there are only really two core questions, right? When we say 6.75, are we averaging 6.75% return over 5 or 10 years? And if we are, then I think we're done. We're doing our job. God bless this day is done. And maybe then Vika says, great, let's borrow some money too, because if we're getting 6.75 pretty consistently, that's a really smart thing. We'll save 70 million. And we're going to look, pardon my French, like pieces of crap. Because everybody else who's at 7.25 has dialed in more risk. And in the growth market, they're not getting 7.25, they're getting 9%, right? And then pretty soon, as you point out, Vincent, the bottom falls out. And maybe then we're getting 2 or 3% and they're getting -5. Look, the core question is, can we dial in a discount rate that has a prudent level of risk and then hit it over the long term? Because if we can, then the city can plan. Oh, 6.75%, there we go. And the Vicas can say, that's great. I can borrow money because I'm going to stick it back into the, right? Because you're going to borrow the money, you're not going to stick it under your mattress. You're going to stick it back into the market, right? And try to get the 6.75%. So that's the core. Vince, can we hit our numbers? Can we do that? Have we done it historically?
So let me answer the numbers of where we are,
Yeah.
not as of our end of our fiscal year, because we don't have those formal numbers, but
Right.
we do have the numbers as the end of Q1. And our 3-year return is 6.5.
Yep.
We did not meet that hurdle.
Yep.
Our 5-year return is 4, and our 10-year return is 8.1. So of those 3 different time periods, 1, we've exceeded it. The other 2, we have not met it. Has nothing to do with our peer rankings or anything like that.
Could I add, I think one thing that's very important is that when an asset allocation is adopted, that we generally stick with it. Because I do think, while you're never going to hit forecasted risk levels and returns exactly, we don't have the chart in here, but we did at the retreat last year, just how many times the asset allocation has been changed over the past 10 years. You know, there hasn't been an opportunity to hit any of those forecasts. And sort of, I know that we'd be very lucky to maintain consistency in the staff and in the board there was a prior CIO that took, hedge funds up to a huge level. We've now started, there's been so many changes in the asset allocation. Chris was meeting with our oldest client the past couple of days, who's been there for 40 years. And, they're over 100% funded because they have sort of stuck with the same essential strategy, made some changes at the margins over the years, but shifting, a high risk level to a way low risk level to a way high, I do think it's important to talk about risk, but having a commitment to maintaining that general strategy going forward over, at least some medium term, I think is really important.
So can I ask a pointed question then, both to you and Prabhu, of what's presented on page 6? What is your recommendation to our board? We know what our current allocation is and what the risk looks like. Would you recommend that we adopt any of the other risk metrics and move there today?
I do think if you were to move closer to your peers, like we've all been talking about, given the Vera standard deviation, that would put you at the higher end of the allocations shown here in terms of risk level. I think there's some other tweaks that we can talk about long-term. I think short-term bonds were a very good move based on where we were a year ago. But I know that you likely have the flexibility to shift some of those to slightly longer duration over the long term as well, even if you adopt any of these today.
Prabhu, do you have a recommendation for our board?
Well, at a minimum, I would, as I said before, I would go to column 2, which would at least bring us back to the risk that we had last year, right? But going back, I think consistency is important. But I think there's nothing wrong with admitting to ourselves that we made a decision 10, 12 years ago, and we may not have been right. And maybe it's okay to dial up the risk. I don't think there's any harm in it, because we have to look forward and say, what is in the best interest of our beneficiaries? And that's not being inconsistent. So we're not dramatically going lower or higher, but we're saying, maybe we ought to have taken a little bit more risk, and maybe that should be our stance, and we should stick to it. So.
Mr. Chairman, I would say that, given that the issuance of bond is a different tangent, another subject for another meeting, the only correction I would make before I make a recommendation myself to what Drew said, we don't actually have to meet 6.75% or any return. If you issue the bonds, the unfunded liability goes away. There is not any requirement to have any return other than an immunized bond portfolio. So if you need $100 million 10 years from now, you buy a zero coupon bond and so on and so forth, that will pay off exactly $100 million. So it'll be a portfolio of bonds, and that's how immunization works. In terms of the framework that we adopted last year, which the chair was kind enough to point out to me the last time we met, we made a number of trade-offs. These are sort of compromises that allow us to meet our obligations to the beneficiaries without putting our sponsor at inordinate risk. And if I look at all of the allocations that are laid out, each of them still meet that framework. As you yourself pointed out, that even in a worst-case scenario, the highest risk portfolio only has about a 2% and change worse outcome than the portfolio at the lower end of risk. So I would say given the proposals that are in front of us, the options that are in front of us, as long as they all meet our framework of what is acceptable risk, we should try to choose a portfolio that'll produce the highest possible return, as long as it's consistent with our framework. Because if it's consistent with our framework, and we still are taking different risk than the one that'll get us the highest return, then it's really it's sort of a subjective override. If we have a framework, it's imperative on us to do the two things. One is to remain consistent, because when the downturn comes, let us not do what was done 10 or 12 years ago to dial in risk. So remain consistent, but also consistent with our existing framework, take the maximum possible risk, and that, I would say, argues for the portfolio at 13% risk. It has a couple of other benefits that aren't laid out on this chart. One is that I think it has the it potentially could reduce fees. Because it certainly is among the options that takes hedge funds down from 7 to 5%. And so it also reduces commodities to zero. And I would say one of the big proponents of a zero allocation to commodities is Mr. Buffett, whose article we've got in our packet this morning. So I would say it has these unintended benefits as well of probably on the margin reducing fees, getting a higher return, and being consistent with all of the risk frameworks limits that we laid out at last year's retreat.
Counsel, and then I want to
I just wanted to make an observation, because I think everybody understands there's no right answer here. And obviously, a little bit earlier, we talked about the catch-22, and, you know, even when you de-risk, you are actually kind of, that is a form of risk because you're risking not getting the upside. I think everybody understands that. So, but what I observed in that exchange about the catch-22 is it seems to me that it might be helpful to receive, and maybe this already exists and I haven't seen it, but to receive information from the city that goes into the kind of analyses you get from your consultants, that goes into its worst case scenarios and its best case scenarios and what its real risk tolerances are. Because, for example, if the city says, we don't like what's happening now, it's costing us a lot, but we can live with it. And that might be an argument, you know, we can live with it as long as it doesn't get worse. That might be an argument to stick with what you've got, right? But if the city says, what's happening right now isn't sustainable, like we have to make more or we're in real trouble, that might be an argument for change. And so, you know, like the grand jury report talks about the underperformance, says this is gonna cost us a lot of money. Everybody would agree we're not happy with that. But it'd be nice to know shades of gray in between, you know, stress tested. When does the city really get in trouble? You know, what can it live with? You know, and even in that context, the concept of pension obligation bonds, I mean, that might come up as well. I mean, one thing to remember about pension obligation bonds is you don't have to, the system doesn't have to make its assumed rate of return for it to be a good bet. The system just has to beat your bond coupon rate, right? So you look at those numbers the chair read a few minutes ago, over 5, 10, and maybe you could add a 20-year. Well, if you can borrow then less than those numbers, that's just arbitrage, right?
So this has been going on for a while, and I'll let you comment in a minute, Prabhu, but I want to make a motion that then can become either seconded or not, and then we can have further discussion. But from what I heard you say of the options that are laid out here, from current to the second column is what you think makes the most sense, given what our current accepted risk tolerance is. It is in line with our risk tolerance. For me in particular, I've been greatly concerned of the large amount that we've had in cash that maybe had been a little bit more effectively utilized by having some of that shifted to short-term investment-grade bonds. Not a huge delta, but a little bit of a benefit to the plan. And then secondly, when we talked about our alternative investments, nearly every alternative investment asset class outperformed its public asset class respectively, with the exception of hedge funds was an area that we did not see strong performance in. And this also brings down modestly the allocation to that. So I'm going to make a recommendation that we do a modest shift to the 11.9% risk portfolio. Approve that. Any further decision or discussion to take the risk even higher, I'd like to have at a future meeting, and I'd like that to be considered on more of a glide path basis, meaning that that could potentially happen over the course of 12, 18, 24 months instead of immediate, given the current economic environment that we're in and the market valuations that we have. So my recommendation, my motion is to make the modest shift to that portfolio. Before you comment, do I have a second? Then we can have.
Second for discussion.
Okay, thank you. Now discussion, Prabhu.
Mr. Chairman, just to clarify, I'm not recommending column 2. I'm saying at a minimum, we should go to column 2. Perhaps so I'm going to go back to what Trustee Lanza said, right? In the absence of pension obligation bonds, and if we get that grade, that's a different discussion. What's the greatest probability of us hitting 6 3/4? That's our bogey. And if you look at the options laid out, it would be the 13% risk level, because that's the highest probability of achieving the 6.75. Having said that, we should temper that with current market valuation. How we do that is more science than art, more art than science, because I don't know, maybe it's glide path, maybe we can make a decision to go there. I leave that to the board to decide. I just want to make a comment on hedge funds. The investment team has been very conscious about fees, and I know it concerns our stakeholders, it concerns the city council, our fee levels. So one of the things that we did with the asset allocation last year was we reduced our allocation to hedge funds, and we are recommending through these options a further reduction of 40% to hedge funds. I do want to say that the hedge fund program that we had in place was actually very well thought out, and the managers in that pool of hedge funds that my predecessor selected are actually excellent hedge funds. Unfortunately, we were in a market environment that did not reward those hedge funds, and there will come a market environment when those hedge funds will be rewarded. But having said that, my own personal view is that we don't need to pay 2 and 20 for those hedge funds. And my use of hedge funds is very different. It was used as a risk dampener and for idiosyncratic uncorrelated alpha. My view of hedge funds is that, and that's the reason we have brought it down to 5%, and going forward, we may even make a recommendation to go even lower, is that you can actually get alternative risk premia very cheaply. And so even the types of hedge funds that we will select, even for the 5% bucket, will be very low in fees, and it will have a different objective. So I just wanted to add that.
Since you referenced that, actually, no, Prabhu, that's not what I said. You know, when you think about it, it's not what I said. I'm not looking for the highest probability that we will hit that number or do better. Because as you know, that also corresponds to the probability that we get wiped out and San Jose goes bankrupt. What I'm looking for is the high, is a curve that's as opposed to right? Mm-hmm. So no, you know exactly what I'm saying. So no, I'm not looking for the highest probability we do that or better. I'm looking for the highest probability that we get close, right? Because it's like the dartboard thing, right? I might be hitting these 20s and 18s. I want to hit that bullseye as often as I can. You agree, right? 100%.
I agree with you.
So then the question comes back to you. So which of those do you think gives me sort of some good narrowness in the curve, but gives me a reasonable return? And that's a judgment call. What do you think?
I still think it's the 13%. So I sort of did not paraphrase what you said correctly, but I think what gets us closest is still the 13% risk level.
And we said 12 anyway in the original analysis, so we're close. Yeah.
We're very close. And within that, without being huge spikes. The only thing I'd use to temper that is where the market is currently, that valuations are rich. And people can disagree with me, and God knows I've been wrong the last 2 years. So, in my opinion, valuations are rich, but like Trustee Sunzeri pointed out, there's a lot of monetary policy tweaking, and maybe it'll continue. I don't know.
Well, I think. Look, God, we're going to be doing angels dancing on the head of the pin. Look, the reason why we're booming right now is because we're in the equivalent of the Roaring 20s. The Model T Ford created the Roaring 20s, and this little bugaboo that we all helped develop is creating something similar. The problem with that is that the leading indicator that saw the Great Depression coming was when that technology is fully absorbed, then the productivity increases fall off unexpectedly, very dramatically. I mean, we're still continuing to see the United States and the rest of the world having huge productivity increases as this technology is adopted by, half the people in the world. 4 billion people have one of these smartphones now. So I think it will boom for longer than expected. We're not in a typical cycle. The problem is you can't predict quarter to quarter when it's going to fall off. It will fall off when we've absorbed all the productivity gains from this, but you can't quite predict that. It's too big, it's too multifactorial. So we're in a long boom cycle, but you can't predict when it will end, so how do you deal with that?
Agreed. So we have to look at the long term, right?
Yeah.
So it's hard to predict quarter to quarter.
Yeah.
It's hard to predict even year to year. But longer term going forward, what's in the best interest of our beneficiaries? And at the same time, we don't bankrupt the city, right? So it's a delicate
Yeah.
balance.
Yeah,
Mr. Chair? Can
Yes,
I-
sir.
If I can comment. So a couple of things. First of all, let me say, I applaud you for having this kind of conversation. You have heard me over the years say to you publicly, to the city council and other stakeholders, that one of the things that I appreciate about both boards is that you have very meaningful discussions, and consultants can probably share this. It's not always that you are at a board discussion where you know your board really understand the discussion and really understand the decision-making process and the final decision that is being made. However, that does not translate into always making the best decision. I'm well aware that as a collective board, you understand what you are discussing and that you will make a decision that is reasonable given the data, the information that is provided to you at this point. Unfortunately, we don't have a crystal ball, so we don't know what the market is going to return in the next 3, 5, 10 years. But starting from the comment by our CIO, Mr. Palani, we are a long-term investor. So if you take that as a premise and you're considering investing in the long term, we only investing in the long term in the capital markets because we expect them to have positive returns. And if we are expecting them to have positive returns, that means it will follow that we are willing to take some risk. The question is, which nobody has an answer to, is how much risk? We don't know that. But we can tell that over the last 10 years, we've taken too little risk. The last thing we want to avoid, obviously, is say too much risk exactly at the wrong time. Again, we don't know what that time is going to come. But I do think that we have heard enough, we have enough data points to understand that we should consider dining off that risk. The only thing I will caution you is, number one, once your board makes a decision, we are in this together, and we all going to support each other, and we all going to agree the decision that we made is the decision that was made based on the information at the time, and we have to live with that. Number two, and really just for me, and I'm assuming for some of you, I want to understand some clarification in on the motion by Chair Sunseri. Asset allocations are made presumably to live within for some time, not to be, we don't want to be tactical, we don't want to be making decisions, changing allocations every 3, 6 months, or 12 months. So I just want to make sure that the boards discuss the motion from the standpoint that, if I understood it correctly, is to move right away to the 11.9 risk or the 9.4 risk, whether you're talking about Mikita or Verus, or if it was me, I will split it in half and it will be in the middle. But, or with the understanding, apparently, that more work can be done to determine whether, if the board elects to move higher, do it in some sort of a glide path approach. That second part of it is a little more challenging, and I think it's one that you want to really talk about, whether you're moving to DR now, and then you may want to consider moving later, and what are the data points that you have to consider to determine whether you're going to be doing that or not. I see that action as a little more challenging, but certainly it's doable. But the bottom line is, once you make a decision today, it's the decision that was made. It's not about to be second guess. It's not about, of course, we can be second guessing the public. That's not what I'm talking about. I'm talking about us. We're going to live with it. We're going to move forward. And I'm all for increasing the risk. And just especially to council members' point, understanding that even dialing up this risk, we are still taking less risk than our peers. So I don't want that concept to be confused, that we are just because we are dialing up the risk a bit more than we have so far doesn't mean that we are taking as much risk as the peers have taken. So we still, compared to our peers, we still consider a lower risk. And I think to some of the questions and statements by council, we have been asking the city all those questions over the years, and I think the city, and especially at the last meeting that we had, the joint meeting here, were very clear. That is a very difficult information to provide you, because the city council are 11 minds, and at least at that joint meeting, you could tell that they were even in different areas of the spectrum on that. So with that said, I applaud you for the discussion. I think whatever you decide, we just want to make sure that we live with it and understand that we have to look forward to what's going to happen in the markets. Nobody knows what's going to happen, so we just have to keep that in mind. As you have said, right now the markets are rich, and so, but to that extent, we have a Fed, and we have a president that is unlike any other president in the past, and we don't really know what the future holds. So with that said, I'm hoping that once the decision is made, that we can live with it, and we all support how we're going to move forward together.
So, Trustee Griardi, Trustee Santos, and then Trustee Oswald and Menon, and then we'll wrap it up. But I do just want to say that when we're talking about changing risk, we're actually talking more, getting in line with where we thought we would be.
Yeah, that's fair.
Okay,
Yeah,
this
that's
is really important to clarify. We're not saying we're taking risk up from where we had planned to be all along.
Chair, that sounds like a spin to me.
Ah.
Accurate, I'm just teasing you. but-
Okay, thank you. 'Cause I want to make sure I'm not spending anything.
Yeah, you're buying the beers.
We're focused on risk, and we're running below our risk targets. Thank you.
Thank you. I just wanted for clarification that the asset allocation, as per investment policy, is owned by the board, but we're taking a very strong recommendation by the investment staff, because you guys are going to be implementing that. So we're doing this in lockstep, right? So you should own it as well as the board, and that if anything goes awry, there can't be finger pointing that says, well, you guys, did the asset allocation. I think we're all in agreement now that we're doing this lockstep, that we own both the successes as well as the negatives.
Very well put. And as, Mr. Peña should run for governor of Puerto Rico. I mean. Yeah, exactly. We are in this together.
Great. Trustee Santos.
Yeah, that was well said about we're all together and our expectations, we're not overriding that. I should have been there anyway. I hear you loud and clear. The other issue is that if we have a consensus, then I think that's good on your motion. But if we feel we don't, then wait for the other three board members, so we really all are in together. And then the other thing, does this motion in this 11.9, does it take in Vegas's suggestion? Is that incorporated in the bonds?
No.
No.
So then we should, I really believe we should double
That's-
check that.
That, to me, my sense is, and Vikas, you can clarify, that was sort of separate from the asset allocation discussion, but more a point you wanted to make.
I want to wait my turn. I think is it my turn?
You're up, and then Eswar, and then we're going to vote.
Okay. Let me just first say that I'm disinclined to vote for this motion. So, but I'd like to vote with the board together, if possible. And I want to elaborate why. I didn't want to get this technical at this meeting. But one of the ways to look at pension obligations is to look at the duration. And most of the board here is familiar with the number 14-ish. That's the duration of our liabilities. And just for the benefit of the 0.1% that may not know, it just simply says roughly, on average, how far out do our liabilities go out in the 14 years? That means that our asset allocation should have a duration of about 14 years. Having done this kind of work before, I have an estimate for equity durations, and that's about 25. Okay, and one is, those who live in the bond world think of duration only applies to bonds, but it actually applies to all assets. It's just a matter of when cash flows are received. With equities, a lot of cash flows come in the future, so the durations are longer. 25 is a good number. And even with a 13% allocation, the duration would be close to about 10 years. So we'd be undershooting in terms of what duration we should try to target roughly. So we're under on that front. If you look at the risk of the 11 on the first column on the far left versus the 11.9 where the proposal is to go to, that's a move of about 8%. And if the numbers in our packet are correct, we're about 25%. If we increase our risk by 25%, we'd still be just under our peers. So, and again, if we say that there's some information in wisdom and crowds, even if we don't buy it perfectly, but there's some modest amount of information there, then we'd say, let's get in that direction, and we'd still be under. And as to the valuations, I think it's important to remember that, and I think from what Makita has presented before and what we've heard from other consultants as well, that when we talk about valuations, the concern has largely been about U.S. equities. In fact, there are managers out there that consider emerging markets as undervalued, the most attractive asset class, and so on. Developed markets have languished for about a decade. The non-U.S. large cap markets have very, very low positive returns over the last 10 years. So if we are concerned about valuations, let's be specific. It's the valuation of the U.S. equity market that we're concerned about. And in a sense, if we can get to the higher end of the risk, which is still below peers and still meets our framework as we laid out in terms of the stresses that it would cause to the city's budget, in terms of our own risk tolerance, I would say, I'd argue for maybe a modest underweight in U.S. equities and still try to target the higher risk, which will take care of our concerns about the elevated U.S. equity market, because I haven't heard any concern about emerging markets and developed markets. Now, it is true that the markets decline, they will all go down, but that's probably a temporary thing. In the long run, even though international markets may not have performed well, that's in the past. There's really no compelling reason why the markets in Switzerland and Australia and so on should always underperform. Over the long run, most developed markets, I would say, roughly speaking, should perform in line with each other. So one way to get to the higher end of the risk and yet be cognizant of our concerns about valuation would be to just keep the U.S. equity where it is, so that we are also consistent with the thought that's been expressed around this table, is to not mess with the numbers. Just look at the risk numbers and have turned a blind eye. And we'll largely be still doing the blind eye with the slight reduction or staying constant in U.S. equities to address the valuation concerns. And yet, we'd be moving the plan in the direction of getting the maximum possible return that's prudently possible.
So because I just want to point out that the 11.9 risk there keeps the U.S. equity allocation the same.
Yeah.
And increases developed and emerging markets. So it, in effect, accomplishes what you want. If you move to the two higher risk metrics, you're increasing your exposure to U.S. I'll also point out that in our reports, I think Lara had said that the U.S., or maybe it was Prabhu, the U.S. allocation in our plan relative to our peers is one of the lowest that's out there. It's below median. It's not in the bottom quartile. So we're already very low in U.S. allocation. So just want to make sure.
Yeah,
you're
I
aware
just
of
want to
that.
clarify that is something I'd be comfortable living with. I'm not recommending a lower allocation. I may be the only one around this table that does not think that the U.S. market is overvalued. I think it is roughly where it needs to be. And I think, again, if you buy the wisdom of the crowds, more than $20 trillion is being traded at these levels, and they can all not be fools.
Yeah.
So I think there's
Roaring
some,
in the middle of roaring
it's
20s.
possible it's overvalued, but I would argue that most likely it's roughly where it needs to be.
All right. Do you want to respond, or do you want me to move on to Eswar?
After trustee Menon, may I just? add
Okay,
one?
sure.
So first a question for you, Vince. You said that we're not where we intended to be. By what measure?
The volatility measure.
Okay.
You
so
know,
we-
the
below.
objective that we set
Yeah,
and where markets are running are below that, and so, you know, you could argue
got it.
we could go up. We did discuss at the IC, and staff also concurred and pointed out that, well, we could very easily, and I think probably you pointed this out too, have dislocations in the market that push volatility higher and above and move us
Sure.
beyond
Sure.
where we should be. And this is why my question was pointed to Danny about, are we talking about vol for 1 year?
Mhm.
Or are we talking about looking at a vol number over a long period of time?
Sure.
And he said, this is a vol number over a long period of time.
Sure. So my view is, I'd go back to what Laura said, which is, once you agree on an asset allocation, don't change it too much. And for me to go from one end to the other, I should have a strong conviction that there's something that we're doing was completely wrong. And in my view, in looking at the markets have kind of gone up fivefold in the last 10 years. Do I expect that to happen the next 10 years? I don't think so. So I would advocate a slower change, like you said, to 11.9, and we can reevaluate it. I mean, so I would not be comfortable in making a big change in the asset allocation. You could be wrong twice, I guess it's worse than being wrong once. So,
And it's really not a significant move truly in our public equity allocation.
Yeah.
And even at that level, we're still considerably underweight our peers and traditional benchmarks. Prabhu?
So, Mr. Chairman, the one thing I wanted to point out is going to 11.9, we're not doing anything. We're not increasing risk. We're simply saying we agreed to a risk level last year,
Right,
and
You're
because of the
correct.
environment, we're simply staying where we are.
correct.
I would personally be very comfortable, since trustee Griardi said, you know, even though it's the board's decision, we want to know what staff thinks and we're all in this together. I'm equally comfortable going to 9.8% risk, which is, we're at 8.6, we're going back to 9.4, which is where we were last year. Another 40 basis points, which is column 1, 2, 3, 4, 12.5% risk for Makita, 9.8% risk for Veris. I'm equally comfortable with that option.
Yeah, I'd mentioned as well, you know, my comments around shifting, I think, I don't want to give the impression that that means that I don't think you should make a move now. I just think that the move that is agreed upon now is something that we should try to maintain for some time.
So that raises, I apologize, Chair, I know you wanted to get, that raises the issue, right? Because I'm not the investment guy, you are, and we know that. But I like the 12.5 and the 9.8 standard deviation. How different is moving to that now versus the approach in the motion, which is let's move to the 9.4, 11.9. And that's why in my comments, I made the comment about the glide path. How do you define that? What are the data points? I mean, because I think if we decide that approach, it would be helpful to have those discussions. So whether that part of the discussion is kick off to the IC to come back with something. Is there a timing? Are there specific events? I don't know that. So, I mean, that's the question, really. Do we go right to that number and then glide path to whatever eventually will take us at the 9.8, or is there a strong conviction to just forget the glide path and just go directly to the 9.8? This was more of a question
to
for
me?
everyone, not just for
Okay.
you, not just for you.
But if I'm to answer the question, I'm equally comfortable going right away to either column 2 or 4. But if we want to do a glide path, I'm okay with that option, except that, you know, these decisions, because they're consensus driven,
Yeah.
and we have board meetings and IC meetings, so if we are to go to a glide path, I prefer to have a very clear path where
Yeah,
we're
good
saying,
point.
here's a time frame. We should do this by this.
Yeah, it's a good point.
Absolutely, yeah. Thank you. That was my point. Thank you.
So may I amend my motion to immediately move to the 11.9 risk profile with a glide path over the next 12 months to move to the 12.5 risk
Excellent.
profile.
Excellent.
Would this motion be binding of the glide path, or are you talking
Yes.
about revisiting it later?
No.
It'd be binding, okay.
And can you, Mr. Chairman, define what you mean by the glide path? Will it be a portion of it every month, or a portion of it every quarter? The difference between 11.9, 12.5, how would that be done?
That's the challenge. Yeah, that's the challenge.
TBD.
Thank you.
We also don't have
Thank you,
other-
Gia. So with our CIO to come back to the board with how they will implement that glide path over the next 12 months.
Mr. Chair, may I add to that and suggest that at the August 27th IC, which is only
2 weeks, 3 weeks.
3 weeks away, that I come back with a plan
Perfect.
for consideration by the IC.
Right. So I think you seconded my motion. Will you accept that amendment?
So far, the consent. Do we have, if you believe we have consensus, then I would say just include the other three. But if we have consensus, I would second that.
Okay.
I think we have
I think
consensus.
that's going to depend on the vote. And Vikas, is that something you are more comfortable with?
I'm much more comfortable with that. I would say that, I don't, you know, we get to 8% in terms of expected returns. Now, clearly, as we all know, there's no guarantees, but all we have to go by is expectations. And 8% gets us 60 basis points more than where we are. And so that's roughly $20 million a year if those expectations pan out. So that's a move in the right direction.
Okay, so I'm going to ask for a call to
So
question.
we do have a second.
Yes,
We do
yeah,
have a
absolutely, and
second.
accepted the amendment, yeah.
All in favor?
Aye.
Aye.
It's really good.
Any opposed?
Nicely done.
That was only an hour and a half.
I have one just little thing at the tail end. So when you model inflation, use historical inflation data? I'm looking to anybody that can answer this question.
We use it as an input to the process.
Yes, and do you use historical inflation data as the input?
As an input, but not that doesn't determine the final product. It's weighted as well as some forward-looking expectations.
And are the forward-looking expectations based on past history?
So, no, the historical expectations I can't tell you the exact percentage, how
Yeah.
they're weighted relative to our forward-looking expectations, but our expectations going forward are much lower.
They are,
than
oh, so
the-
that's
than the
already baked in,
experience.
that's what I wanted to know.
Yes.
So when I see that 7.7 number there,
Yeah.
that's got a low, you buy the
Yes.
theory that inflation isn't like it used to be?
Exactly.
Yeah, good, okay, that's great. Because the problem with that, Vince, is if we really implement this, we gotta raise our discount rate, which is gonna hurt like hell.
Okay. Thank you very much. Let's move on to 2C as quickly as possible.
Quickly.
Okay, we're gonna pivot here.
was a very good discussion.
Yes. It was very good.
We're gonna pivot here from public to private markets, noting the presentation titled City of San Jose Police and Fire Department Retirement Plan.
Before,
Private
I
market
apologize,
proposal.
before you continue, can staff hear his comments very well through the microphone? Are you okay? No? Can you get them back up? Thank you. Get it closer and speak louder.
I apologize.
Thank you.
We're going to pivot here from public to private markets. The report titled City of San Jose Police and Fire Department Retirement Plan, Private Markets Program as of December 31st, 2018. We'd also like to note that this is the public version of this report, and staff receives a more in-depth private version of the report. Page 2 outlines a table of contents. We're going to start on page 3, which details the total private markets for the entire retirement plan. The total alternatives account is detailed there on the top row, again, as of 12/31/2018, and it consists of just over $1.3 billion in committed capital, a market value of $510 million, on total contributions of $917 million, which has received total distributions of $653 million, which equates to a total value multiple of 1.3 times and a net IRR of 8.1%. The total alternatives account does consist of legacy private equity, the Neuberger Fund of One, private debt, real estate, and real assets. We're going to start with asset class returns for private debt, which you'll find on page 5. As a reminder, the private debt program for the retirement plan consists of 11 private debt partnerships, committed capital of just under $500 million. The current market value equates to roughly 5.2% versus a 4% target. In the fourth quarter of 2018, $0.6 million was contributed to the private debt program, while $15.8 million was received in distributions. There were no new commitments to the private debt program. If you flip towards page 8, you'll note all 11 partnerships are detailed. This consists of 10 of your more typical private debt partnerships and one separately managed co-investment. That would be through your vintage year 2017 investment and Arrowmark Partners separate account. There are several columns on this report. We would like to draw your attention to IRR and investment multiple. Those are the two most meaningful measures of performance. Those are located in your far right-hand columns. Just some quick, notes on private debt. Again, we had touched base on markets here in the fourth quarter. The fourth quarter was a very rough market environment, one of the worst quarters for performance in markets since the Great Depression. This was consistent in your private debt program as well, while performance for the entire program decreased roughly 50 basis points from 6% to 5.5%.
Can I ask a question here?
Sure.
On this page 8, the benchmark that's listed on the second column from the far right, is that an investable benchmark?
No, so these are Cambridge Associates benchmarks, not investable benchmarks, made up of a peer group of similar funds from those vintage
Is it
years.
possible to approximate an investable benchmark? Would that be, say, a high-yield index of some sort or some other index that give us an idea of what's doable if we didn't want to be in a private debt instrument in the future, in this asset class?
So one thing we do see from other clients to gauge an investable benchmark would be adding a expected return above public markets that you could expect. So you could take the high yield benchmark at roughly 2%, 3%, 4% as an illiquidity premium, and that would be a more investable benchmark that you could gauge performance on.
So it'd be a-
Gauging past performance is difficult because these are drawdown structures, so it's very difficult to you'd have to take every cash flow, every date that they called capital, and sort of adjust the public markets benchmark valuation on that date. So judging historical performance on that granular level is difficult, but like Chris said, many people use dual benchmarks for their private programs, that one is a peer group and then one is a premium over public markets, just, as a rough estimate.
So if we were to use a proxy of a premium of, as you said, 2 or 3%, and you did some approximation for the cash flows, so to compute something that's close to an IRR, do you have a guesstimate of what that might be? At least for one of these numbers? I don't want to put you on the spot
Yeah.
for all of them, but
Yeah, since you started investing in 2010, the program would have underperformed that benchmark. I can't give you a number off the top of my head. I will say, since the current staff has been in place and the process that we've had working with them, the returns have been quite strong. So I believe that the returns for the program for, say, funds since 2015 would have outperformed high yield. But for the program as a whole, for its full history, I don't believe that would be the case.
the one row that I was looking at where one can say that this program has had time is the vintage year 2010, which also was an exceptionally good year.
Yes,
If you
it was.
think about starting point, it was only a year or so after a blowout in spreads. So it was a great year to start, and those returns, to me, look very, very tame.
Completely agree. Those are direct lending funds, and originally, these funds were not in a private debt allocation. They were in something that was called opportunistic at the time. They were then put in the private debt bucket. So the staff at the time was trying to take advantage of middle market lending being constrained. So these funds were not designed to have as high returns as traditional private debt that we're now investing in, and then they were stuck in this bucket later. So completely agree with you. We would expect higher returns from private debt investments going forward.
Okay, thank you.
There are no further questions on private debt. We'll continue on to real estate, located on page 12. Real estate for the retirement plan consisted of 13 partnerships, committed capital of just over $216 million. Market value consisting of roughly 2.5% for the real estate portfolio versus a 3% target. In the fourth quarter of 2018, there were $7.5 million in contributions, $9.8 million in distributions, and no new commitments to note in the real estate portfolio. If you'll flip to page 15, that would hold the performance summary for the real estate portfolio. This details performance of the 13 closed-end real estate funds that you all are invested in. We'd like to note that the private real estate has fared very well in the retirement plans program, with a net IRR for the total program of 14%. Again, even in real estate, the fourth quarter was the lowest returning quarter for the asset class in some time, in this case since 2010, due to a decrease in asset appreciation in the quarter on increased market uncertainty that we saw in that time frame. We'll continue through to real assets. Real assets will be located on page 19 of this presentation. The real assets program consists of 3 partnerships on $46 million of committed capital. Fair market value would place the program at 0.8% of the total retirement plan versus a 3% target. In the fourth quarter of 2018, you've seen this program start to grow a bit with $1.8 million in contributions, $0.3 million in distributions, and a new $6 million commitment. If you'll flip to page 22, that would detail your commitments here in the real assets program, consisting of your 3 partnerships, 2 of which are infrastructure, 1 of which is an energy investment. And it's worth noting that in the fourth quarter, we did see incredibly volatile energy markets. You probably noticed that the gas pumps price of WTI fell from $75 to $46, and was a notable performer for energy markets.
So the one with the very low IRR, 0.9, was that an energy? What does that mean?
So that is your Global Infrastructure Partners 3. That is an infrastructure fund.
Oh, infrastructure. Do you know what's going on with that, or?
So can we say that in open?
Yeah, our problem is that sometimes we can't discuss specific funds or specific underlying investments in public session. There was a write-down of $1 billion on one investment just in this quarter. So it was a significant write-down. We still do have conviction in the manager. In fact, made another recommendation to invest in their next fund. It's still a very strong manager. So we can get you some more information offline about that specific investment.
Yeah, it'd be interesting.
Yeah.
That's a big write-down.
Yeah.
That kind of concludes our comments here on the private markets report, unless there are any further questions.
Question I have is about managers in terms of numbers. One of the comments that has been raised or statements that's been made about our plan is the large number of managers that we have. And if you look at it, it's predominantly in private markets. We don't have a large amount of public managers that we're using. And so I'm not sure how you tackle that solution unless you choose to go to single manager sources that bundle everything together. But it appears that it's being presented as if San Jose is kind of this outlier with all these managers. Can you give us a sense of your other clients and if in fact that's true or not?
That's definitely not the case among other clients that we work with and that we know of in the marketplace who work with other consultants. This roster of having dedicated allocations to private equity, private debt, private real estate, and private natural resources or real assets, I know that it's always been a goal of the boards historically to not have too many managers, and that's why you see that in general, the lowest allocation you've made is somewhere around $20 million. As an example, in your real estate portfolio, we've always leaned towards the DRAs of the world, which are more diversified private structures, because we know that there is a desire not to have a proliferation of managers. So compared to other large institutional investors that invest in alternatives, the number of managers is quite low.
And it's the same thing in the private equity world as well, right? Where you want to have your vintage years exposure,
Yes.
your different strategies within private equity. I just want to, I guess, kind of hear this out publicly before we go to that part of our agenda, because I know this continues to be raised, and maybe the comparison needs to be done, separating out the alternative managers that we have in the universe and the public managers. So, thank you for clarifying that
Yeah.
and confirming what I thought.
I think what, going back to that, I'll touch on it briefly. There needs to be like a look-through if other funds are only doing a fund of one. There needs to be a look-through to see the underlying number of underlying managers.
Good. Okay.
I have
Any more
one
questions?
question, yeah.
One more question.
Now, I realize there's not a perfect answer for this, but given the fine performance in the private real estate market, what's your current view on valuations? Are they roughly right? Are they still attractive? Are they modestly overvalued, value overvalued? Where would you,
Yeah.
what's your subjective view on valuations?
We think they're expensive and highly valued relative to most other asset classes. Or, I'm sorry, similar to most other asset classes. So we think probably modestly overpriced, but perhaps U.S. equities and other, areas that you're investing in are also modestly overpriced. We don't think that real estate is a screaming buy or a screaming sell at this point.
May I add something? So I do speak to some real estate managers. Dinesh does that all the time. Occasionally, I get the opportunity to talk to some of them, and I do question them on that. And what I hear from some real estate managers is that, yeah, in general, markets are pricey, but there are specific areas within real estate where there are some good opportunities.
I think underlying all of this is the fact that interest rates are so low. I mean, every part of the Swiss yield curve is negative, right? I mean, and that's why to me, I think what's driving the markets is it's interest rates. I don't think it's growth, because global growth actually is cratering right now, in my view. But
Okay,
Thank
thank you so much.
Thank you.
As we talked about earlier, we're deferring item 3A, so we'll move to 4A, oral update from the CEO.
Thank you, Mr. Chair. So you bear with me for 2 or 3 minutes. When you came into the meeting this morning, a few hours ago, you had the no known conflicts letter handed out to you. So when you get a chance, please review it. Let us know, or fiduciary counsel, if you have any questions. And once you're ready to submit the letter signed off by you, make sure that you either give it to us at a committee meeting, at a board meeting, or send it to our office in attention to Linda Alexander. We have 5 positions right now that are available in the office for which we're doing a search, starting with the information technology manager, the investment financial analyst, account clerk, office specialist, 1 senior benefit analyst, and I just learned this morning that we are also losing another benefit analyst, so that will be 6. So we're working through that. We'll keep you posted. In June, after your board meeting, we actually issue a letter to the retirees. I mentioned it throughout the meetings last time, but we were making changes to the pay stubs. And so the letter went out to retirees, I believe, at the end of June, just indicating what changes were made to the pay stub so that they were aware there were some changes being made in terms of the information provided. The financial audit for June 30th is ongoing. The auditors spent 2 weeks at our offices in July. And lastly, I wanted to let you know, it appears that was yesterday that we actually had the improvement made to our offices and moved everyone together into one floor. Well, the rental agreement, I think as to 5 years, is coming up early 2020. I don't know if it's February or March. And so just want to let you know, we're gonna be coming to you, board, in October. We are doing some research as to what our options are. In fact, Dinesh from the investment staff is actually taking it upon himself to seek other options in the area to compare not only location, but cost and options for rental. Because we need to make a decision about 6 months before whether we're gonna sign up a new agreement or not. And the agreement that we have right now, it would include some increases. So we may be coming before you in October with the results of that research and to find out whether we in fact gonna decide to stay in our building or whether we're gonna be seriously considering moving locations, probably very close to our area. In fact, some of the buildings that we're looking at, one of them is right next to us, the other one is in the front, about 500 yards to the right. So they're not far, but we're looking at options. Just wanted to let you know. That concludes my comments, Mr. Chair.
Any questions? Councilmember Foley, do you have questions? No. Okay. Well, I guess we're up for update from Councilmember Foley.
Councilmember Foley has been on vacation for the month of July.
The
So
month.
Councilmember Foley has no update as of. Look, it's very nice that council shuts down in the month of July, although my staff was busy at work. I was not and took advantage of it, so.
Perfect.
I have nothing to say, but thank you very much.
You bet. Okay. 4C, discussion and action on Cortex Consulting Services Agreement.
Thank you, Mr. Chair. So let me be quick. You have a memo before you, and attached to the memo is a suggested agreement signed by Cortex already. We have been working with Cortex now for a few years, and so there is some work related to board governance, not the least of which includes work on personal issues that we're going to be discussing with the JPC in the next few months. And so we are recommending to have a new agreement with Cortex for the calendar year 2019-2020 for an amount not to exceed $45,000. You should know that when I sat down with Cortex to go over some of the possible work that it may be needed, the amount suggested was actually lower than that. Requested $45,000 just so to make sure that we have enough flexibility in the event there's more work to be done. But I guess my point to be is that the expectation is not to fully use for the $45,000, although of course if we move ahead with this agreement, we have the amount not to exceed to $45,000. The agreement was reviewed by Fiduciary Council. It was provided to Cortex. They signed off on it, and I'm happy to answer any questions. Yes.
So what is it exactly that Tom will be helping us on? Is it more around like the performance-related stuff for JPC?
So there is that side of it, performance metrics, but there's also, you may recall, I believe you were the chair of the governance committee sometime back. We haven't met in about 9 months. There's still work to be done. In fact, the next joint governance committee is scheduled for, September 5th, which is the day after your board meeting in September. So there's still work to be done in governance. Work that there was some basis and some work done about 9 months ago, but we still need to actually perform more work. And so the reason for hiring him was for that and the governance work and the JPC.
Okay, I thought we finished the governance, but okay, there could be some stuff hanging out there.
Very well.
Any other questions?
I have one question. From what I've seen in the past, they've certainly done good work, and the cost is not huge. But I just want to ask the general question. If we did not continue the service, what would go wrong?
Well, I guess hypothetically nothing will go wrong other than the reason we are still requesting their services is because it's work to be done. But I guess to answer your question, once all the work that is governance related is completed, you're absolutely right that there wouldn't be any need to rehire them. Other than any governance work that have been done in the past about charters for different committees or positions or boards, there's a requirement to be reviewed every so many years to to make sure that, we are staying up with the times. And we certainly does not have to have Cortex or any other board governance firm at that point, but in situations where we are reviewing the kind of work, it may be a good idea to have someone available. But to your question, once all the governance work is completed, you're right, nothing will go wrong.
Thank you.
Do we have a motion?
I'll second.
Okay, any further discussion? All in favor? Aye. Any opposed? All right, thank you. 4D, discussion and action on proposed annual member statement for reclassification.
So thank you, Mr. Chair. So this memo actually comes to you from Jennifer Chambry, Director of OER and also Director of Human Resources. Cheryl is here to speak to you on the matter, but before she does that, I just wanted to remind you, this is the situation of, your board discussed this with Karen for some time about members that are Tier 2 that have the chance to move back to Tier 1 and to pay for the cost of moving from the Tier 2 benefit structure to Tier 1. With that said, I'll turn it over to Cheryl.
Thank you, Roberto. That was a good introduction. So right now, we do have about 12 of your members who are repaying an extra contribution rate because they were reclassified from Tier 2 to Tier 1. And so the city's request today is that you authorize Chiron to provide these members with an annual statement. We believe this will help in two ways. One, each member will now know how much they have been contributing over the year and how much they have to pay back. And secondly, if one of these members leaves the city, the board's actuary does have to calculate their payback amount. So Chiron will now be able to kind of just pick up from where the last annual summary left off, and it'll be easier for them to provide the member with that number. So just here to request that you do authorize Chiron to help prepare this annual statement for these 12 members.
And to add to that, I just want to share with the board, our office and myself included, we are in complete support of that request. We reach out to Chiron, and I just wanted to share with you, there will be an about $1,500 to $2,000 per plan cost on just the initial design of the statement. And then after that, about $1,000 to $2,000 a year for the whole plan to issue the statements. And so I'm in full support of it. That cost will be borne by the retirement office, as these are retirement contributions related statements, and happy to address any questions.
Any questions related to that?
I have one question, mostly because I'm not as informed on the details. But what's required before an employee requests reclassification from Tier 2 to Tier 1? Can all? Yeah.
Carol can correct me if I get this wrong, but I'll just answer really quickly. This is a leftover from all of the Measure F and Measure B, and so initially there was there was a change in tiers, and then there was a change to that change. This is sort of a cleanup from that. Okay. It's not normal that you would have members moving from tier to tier.
Okay.
Thank you, Council. Yes.
Thank you.
Do I have a motion? Question?
Why do we need the actuary to provide the statements? Why couldn't we do that internally in our finance?
That's a very good question. It's really, if you recall, unlike the regular retirement contributions, which is for the full plan for all the members, these, your board actually made decisions on some of the questions that Chiron requested to be addressed so that they could then prepare these kind of costs. There are different costs. People come in at different ages. They have different timelines or timeframes to retirement. Okay. So there's a lot of complicated data that goes into requiring someone as bright as perhaps an engineer like Trustee Lanza or an actuary like Mr. Hallmark to prepare those statements. That's why. We don't have the capability to do that.
Fair enough.
Okay, so I have a motion from Trustee Santos. Do I have a second? Okay. Any further discussion? All in favor? Aye. Any opposed? Okay, motion carries.
Thank you very much.
Item 4E, discussion and action on the appropriate response to the County of Santa Clara Civil Grand Jury Report. Hopefully, you've all had the opportunity to read through this report. In that report, 31 pages, there are specific recommendations. And there is a request of myself as board chair and Matt Loesch as board chair of the Federated Board to respond within a specific timeframe to the recommendations. And it's on page 27 of the report. On page 27, they list the findings and the recommendations, and they are looking for responses from us from findings 1, 2, 3, and 4B. I did have an opportunity to speak briefly with Chair Loesch of the Federated Board. I think it's important that when we respond together, as our boards are really looking at the same challenges and issues. Although there were different aspects that were brought up within the report, the differences of the two plans, there's a lot of similarities as well. And what I'm going to propose is that we are granted the latitude to work with council in drafting a response to meet that requirement. There are some things that we can respond to directly. I'm happy to address some of those items here, but I think it's also important to point out that there are some items they're asking us to respond to that are unrelated to our responsibility as board members. For example, recommendation number 3 talks about the burden on the board and considering combining boards, I believe was one of the things that they were addressing. That is a bargained agreement, something that is typically worked through with the city and the unions, not the board. So it wouldn't be appropriate for us to respond as to what our opinion is of that. However, recommendation number 1, we could certainly respond to the fact that they would like us to review other strategies of other systems that have very similar characteristic to ours, but may have different investment performance and better investment performance. Certainly makes sense for us to be doing that type of work. Much of that work is, some of it has been done at the last retreat that we had, and some of that data was also presented to the city council at the joint meeting, but there's more work that could be done there. So in essence, I think it's important that we do respond to this. There's a lot of salient points that they brought out. That's my recommendation, but I'm curious on input.
Yeah, I agree 100%, Vince. I think we've been round around on this with the city auditor. I think we say recommendations 1, 2, and 4B are all good exercises. We should undertake them. I think in general with things like this, unless they do something egregious, I don't necessarily agree. I think egregious, think we ought to say, thank you very much, we agree, and we're on it.
Yep.
That's always worked well for us in the past. As you say, it's a useful thing. 1, 2, and 4B are all useful exercises. We would have gotten around to sooner or later. Let's do them now. I agree with you 100%.
And then what we could do is come back to the next board meeting and point out where we would tackle that. Some of these items may be staff items. Some of these items, for example, 4B on performance metrics, we're already going to be discussing those things at the Joint Personnel Committee. I'm chair of the Joint Personnel Committee, so it makes it easy for us to move those items forward. But so that way the board knows, 1, what the memo was, and 2, how we intend to do the work to provide the reports, because there are specific timelines that they have in mind. They're looking for responses by various states.
I think also, Mr. Chair, that you look at, there'll be some areas of clarification. They may have not got all the facts, and we look at our records and say, well, we have addressed that, and here's the other issue in terms of combining boards. You may look through the minutes, there may be some past discussions that you might be able to submit along with saying this is city council and bargaining responsibilities. But here's some notes that were taken in discussions in the past.
Yep.
That might be helpful.
Good. And I think that's important because, for example, on finding number 2 and recommendation number 2 is study ways for us to reduce cost and investment managers. As you saw by my question earlier, it's not unusual for institutional investors to have a lot of managers in their alternative investment plans. We can get data from our consultants and others to reflect how many managers in the private space other plans are utilizing. And we're obviously mindful of cost. We're working on it. I know we've done reports on our fees. I think we need to do a much better job of explaining. We do a good job, but I think we can enhance the job we're doing of explaining how much more thorough our process is in including fees that maybe other systems are not including, particularly performance-related fees. And then specifically the actions that we're taking to continue reducing fees and addressing that where we can. Other thoughts around this? Councilmember.
Just a comment regarding, and I agree with the separation of, some of these are definitely city council, City of San Jose responsibilities and bargaining unit responsibilities, and others are the pension boards. But I noticed one that is more the pension board that wasn't mentioned, and that's finding 5 regarding diversity of individuals who serve as trustees. That, I would think, would be something that this body would want to take a look at. How are we going to expand the type of representatives we have sitting around the table here?
So that's an interesting one, and I guess my initial thought was that is actually something, the construction of the board was determined by the city and approved by the bargaining units. This board never had any input, nor did we have the ability to say what we thought the board should look like. So I'm a little afraid of encroaching on that responsibility of the city and the unions.
Okay, I guess I need to dig into this a little bit. So, are all the people who make up the trustees, the board, designated by the agreement with the bargaining units?
My understanding is that, Cheryl, maybe you can help me with that?
It's set by the municipal code, and the municipal code is not specific to say that only investment professionals should be on the board. It's actually much broader than that.
Okay.
And so and while it is up to kind of the bargaining of the city, it just so happens that there are a lot of investment professionals, particularly on both boards now. So, the city was going to respond to that because the civil grand jury has indicated it on its report as something that, we should look into. So
Okay.
we were not contemplating, a joint response on that.
Got it, okay,
Yeah.
thank you.
So let me add to that, because I have actually raised that point here before, about trustees and service, completely right, that this is, it was created by the meetings with the bargaining units and by the city, and ultimately the city council is the body that actually appoints the members. And as you indicated very well, Cheryl, it's very clear that investment is just one of the areas of knowledge that is required. It's very broad. I mean, it's very business general specific. It just so happened that the majority of the members over the years that have been willing to apply for the positions are investment related. I suspect because of the sizes of the plans, and it's interesting to investment professionals. But we, I don't know if you were at one of the meetings, we had discussions with the boards, because what I find interesting is that even though the appointment is by the city council, I guess it's left up to the department and the boards to seek out applicants.
So typically.
Which I never understood
yeah.
that. So let me finish the thought and then you can address that issue. But the point being is that the boards gave staff direction so that we now make sure that we reach out to different organizations so that it's not just investment related, right? In the past, we didn't have any kind of reach out approach, and people that really, members of the public that apply were investment staff or investment professional. But now we're reaching out to hospitals, to educational, to the unions, so that we're hoping two things. We're hoping that we can actually reach out and have more applicants interested and letting them know this is available so they can apply. But in addition to that, having people from different backgrounds. So just.
Right.
And
And I
can-
recall that coming up in our last meeting,
exactly.
as how you were going to reach out to others.
We started doing that.
Yeah,
Okay.
And let me also expand on that too, having been through the interview process and the application process a couple times with city council, it's very clear on the criteria they have. We are independent, we're not members of the plan, but there's a criteria we have to meet in terms of having experience, institutional experience with retirement plans
Oh, right.
or benefit plans. We had previously on this board, some years ago, someone who had HR expertise, so that applied. When I reapplied for the board and went through the interview process with city council, there was another individual who actually had been an actuary, was not selected by city council. So we do see those individuals come up.
Okay,
They're not just investment
right.
professionals.
thank you.
And just one more item, I know exactly what you were gonna comment, Cheryl, but to your point, I've been told, and I've seen it, I know it's true, the application form actually is sort of tilted towards investment questions. And one of the questions that I have asked OER was, who is in charge of the questions? Can they be changed a little bit so that they be more general? Because they are sort of geared to our investment questions, which
Absolutely.
lead you to believe that what the city is looking is people with investment background.
Yeah.
So my point is, somebody else that is looking to apply, they see the form, I said, I'm not gonna apply because I don't know the answer to those questions.
That makes sense.
So that's a good question that we may wanna work on, is there a way to change the application so that it's a more broader in questions, so that it does key in on investments, but also in other areas of expertise.
And I'll also point out, again, in the letter, and the responses they're requesting, from the city, they're not requesting responses on items 1 and 2. For the Police and Fire Board and Federated Board, they're not requesting responses on item 5, 4A, or 6.
Got it.
So
Okay.
it's a bit of division of question responses.
Okay, thank you.
Sure. Gio?
Roberto actually asked the question that I was going to ask.
Okay.
Yeah, and I
So-
think, so, and sorry
ahead.
to interrupt, but just to respond to that question, I think that that would be something we need to work with the city clerk on. Believe it or not, OER actually doesn't handle one thing in the city, and that's those particular elections or applications. So something that we can definitely work with the city clerk on to fix.
Thank you so much. I apologize, Shirley, because I just think that you guys get involved in everything. And I assume that you also do that.
And
but,
sometimes we do.
I do know that I sent that email to someone. I probably thought it was to you, but it may have been to the city clerk. I apologize.
Can I add just one thing? And I mentioned this at a previous meeting. The form is long, so if there's a way to shorten it. And for many jobs, in most sectors, public and private, a resume is enough. So I'm wondering if we can shorten it to make it more likely that we'll get a large pool to draw from.
Thank you. That's a very good point, because I must add that Federated is short two seats, and we started doing that reach out that we discussed for Federated, and we actually have 2 seats and already have 3 applicants and one person that was pursuing. I don't know if the person ended up applying or not, but I did get to hear from a couple of those applicants, and they say, wow, this application is really long. So again, I suspect that some people may look at the application, and when they see it, they get discouraged from applying.
Sure.
So, I mean, as you said, maybe a city clerk going to the city council, but that may be another option.
It's intimidating.
Yes.
Yep.
You're right.
The last thing I'll say before I ask for a motion here, which is really interesting, on page 28 of their report, they actually show trailing returns of the plans, 1 year, 3 year, 5 year, 10 year. You may recall that I mentioned earlier, the 10-year return for our plan as of March 31st was 8.1%. This shows 4.6. The difference is 6 months. In a 10-year period, the difference of 6 months, the return of 4.6 versus 8.1. Pretty fascinating. I just want to point that out because,
What, because it captured 2008, the crash?
well, I think that's what happened is your number, your 10-year number, that drops off the crash and picks up the recovery.
Yeah.
And so statistics are a very interesting thing.
Yes.
And depending on what time period you select or utilize, it could look good or it could look really bad. And when we talk about evaluating success or failure, we typically talk about longer periods of time. But even that 10-year number, you can see the dramatic swing because of the crash. So I just wanted to point that out. But what I'm looking for is authorization or approval from the board for myself to work with council, Roberto, and Chair Loesch on the Federated Board to draft a response.
Second.
Okay. Motion from Santos, second by Lanza. Any further discussion?
I think that one thing that I did want to bring up is because we have just recently had the July recesses, not only for your boards, but for our city council. The city has requested an extension of the 90-day response time, so it was going to be September 17th. Noting that you probably would want another board meeting and Federated would want another board meeting in addition to the city needing to respond. We actually did request an extension on both the city and the board's behalf. So while that may have been something but we needed to come to the boards and ask, we did ask for an extension on all of it. So willing to take any feedback on that.
We'll always take an extension.
Who
Yeah.
knew?
Yeah.
Who knew city council was working on our behalf?
Really, we should probably be the party asking for it, but if it's granted, who cares? We'll take it.
So are you saying it was granted, or are you?
We actually do not know yet if it was granted.
Okay, well, we will work off of the understanding that we have a timeline to meet. We'll work to meet that. I've already had a conversation with Chair Loesch. They've got a board meeting coming up, so they will be addressing the same thing, and the hope is that they will also grant them the latitude. In the event that his board does not grant the latitude, then I think we look to see if we got that extension and go from there.
Absolutely.
But just to be clear, this board is going to respond on its own, because if we have disagreements with the city, it's impossible to resolve them, so our responses will be.
That's correct.
Yeah.
But I don't mean on our own, just the police and fire.
I'm
I
sorry,
would like
the
our
boards.
response to be in coordination with Federated.
I'm sorry, I was just making a distinction with the city, is that even though the request for extension was requested together, that doesn't mean that the response is gonna come together with the city, that's all I meant.
Would you let us know if it was granted so that I can share that with the boards?
Absolutely.
Thank you.
Okay. So we have motion second. Any further discussion? All in favor? Aye. Any opposed? Okay, thank you. Where are we? Ah, 4F, discussion and action on committee assignments.
Oh, yeah.
Okay, so if you pull this up, it has a list of committees. I'm actually making a request here and have reached out to several individuals in advance regarding the investment committee and changes to the committee. I've spoken with our CEO or CIO and the chair of the committee in advance of this, as well as the board vice chair. I think it's important to think about a couple things. One is that we have new trustees. We didn't want those new trustees to, even though they have very strong investment background, jump right onto the committee without having gotten their feet wet and maybe staggering the terms a bit. We have trustee Oswald has been on that committee since he joined the board. And my term on this board, I still have another year and a half to go, but I think it's important to start thinking about succession planning. I think it's important to be thinking about the fact that there was a tremendous amount of work done last year with staff, Cortex, and the board to delegate a tremendous amount of authority and responsibility to staff and making many decisions and allowing them to run with those decisions. And so what I'd like to propose is that I actually come off of the investment committee and add trustee Ezra Menon on the committee. I think another factor that's critical here is that we really need to do some heavy lifting on the Joint Personnel Committee, and I'm chair of the Joint Personnel Committee. We've struggled to get meetings, and it just needs to be a higher priority. We need to, one, respond to the grand jury's report and the performance metrics and beef that up. So that will be one body of work. Another important body of work, I think, for that committee will be us starting to look at incentive measures, ways to, if we can, tie compensation to plan performance. We all want better plan performance. And one thing that might benefit us from retaining staff, motivating staff, is seeing how we can develop something like that. So I just see that being a really important responsibility. What I hadn't thought about, Trustee Menon, when I reached out to you, is that you're already on 2 other committees. So one consideration here is I don't want to jump off investment committee and then jump on another committee, because I, again, want to have my focus on both the board and the Joint Personnel Committee. But we may want to consider Trustee Oswald replacing you on governance. Right now, Trustee Menon is on audit. He is on governance. We'd be added into investment. That'd be 3 committees.
Yeah,
That's
too
a heavy load. That's heavier than everyone else.
Yeah, and he's got a long commute, too.
Yep. Trustee Oswald is on the investment committee. He is alternate to disability, but he's the second alternate. So I just think if both of you are open to it, and I did briefly talk to Oswald when I got here this morning as I realized that, but I hadn't
I'm
talked to
good, yeah.
you. That would be another suggestion, is just make that one switch.
Yeah, I'd like to keep Ezra on the audit committee, so that's great, yeah.
And I think, Trustee Oswald, you also
Sure.
have, strong ideas on things, and I think that would be beneficial for governance.
Sure.
As Roberto had mentioned, it's been a while since we've actually had meetings there. We need to get our committees active and engaged. So that's what I am proposing. Let's have some discussion around that first before it's actually a formal motion. Is anyone opposed to that or have any challenges
No,
with that?
I think you, obviously, you put some good thinking towards that, and I think it's fair. It's a good balance.
Yeah, it makes perfect sense to me. It's a good call, Vince.
I didn't hear you, but I think it makes a little sense.
We talked about that. And most importantly, I talked to Trustee Griardi, who is chair of the investment committee, and Prabhu, to make sure that they're comfortable with that. One of the things I think that can be valuable is that, having been on the board for a long time, there is a lot of institutional knowledge. We don't want to lose that institutional knowledge. However, in between board meetings, I do meet monthly with Prabhu, one-on-one, and that will continue. So it still allows me the opportunity to impart that as things come up. So I don't feel like we're going to lose that.
Yeah, it's great.
I think the only question is timing. Do we make this effective now? And as I looked at the schedule, we are really at meetings every other month now for the investment committee. So there would be a meeting now and then 2 months from now. I'm comfortable with the change being effective now, but if we want to delay it until after the August meeting, we could do that as well.
Now it's as good as ever.
Are you able to make it?
Yeah.
Okay.
That's good, yeah.
And the reason is, Vince, that major discussion we just had on 11.9 and all those things, timing's right.
Yeah.
Good.
Great.
For the record, Vince, you'll be missed on the IC.
Thank you, thank you. And as Prabhu pointed out, you could still come and be in the audience.
It's not nearly as much
They are
fun.
public meetings.
Yeah, but absolutely. But, it's good. Also, I think it helps Andrew out, the vice chair, thinking about, okay, you want stability. It gives a 6-month runway with that change, because he may need to come off the investment committee possibly when he becomes, hopefully, the board chair. So, anyway, that's the motion I'm making. Let me just confirm it again. I will come off investment committee, trustee Menon will come on, trustee Menon will come off governance, and trustee Oswald will join the governance committee.
I will second that motion.
Okay. Any further discussion? All in favor?
Aye.
Any opposed? Great. Thank you both for accepting that.
Good call, Vince.
Good.
And
All
yes,
right.
Vince, you will be missed in the IC.
Thank you. Okay.
I feel compelled to tell you that too
No, you don't have to revert.
Too late, Roberto.
Pile on, brother, pile on.
Okay.
Behave.
Retirement. 5-1, we have about 5 retirements. I'll read them off. Colin L. Crooker, police officer, Police Department, effective August 10th, 2019, with 22.56 years of service, with reciprocity. Robert Finney, Police Sergeant, Police Department, effective August 24th, 2019, with 25.03 years of service. Eric Hernandez, Fire Captain, Fire Department, effective August 10th, 2019, 25.18 years of service. Christopher D. Proft, Police Officer, Police Department, effective June 26, 2019, 26.51 years of service. Do I have a motion to approve? Do I have a second?
Second.
Okay, motion by trustee Santos, second by trustee Oswald. All in favor?
Aye.
Any opposed? Okay. There's one fire, the rest are police, and we don't have any police members here, but trustee Santos?
I worked with, it seemed like, the young Eric Hernandez. He was on about 5 years when I left, and I see he made captain, so the best to him.
All right,
Wonderful. Yeah.
good. All right. Then we have a deferred vest, Parker L. Hathaway III, police officer, police department, effective August 31st, 2019, with 26.5 years of service. Motion to approve?
So moved.
Second? Okay. Again, motion by Santos, second by trustee Oswald. All in favor?
Aye.
Any opposed? All right. So now I'm going to read off the death and survivorship notifications, and then I will ask for a moment of silence. Notification of death of Russell Hanson, police officer, retired June 6, 1998, died June 6, 2019. No survivorship benefits. Franklin Jost, fire captain, retired April 29, 1979, died June 10, 2019. Survivorship benefits to Clarice Jost, spouse. Philip Norton, police lieutenant, retired March 2nd, 1982, died April 22nd, 2019. Survivorship benefits to Joyce Norton, spouse. Philip Rice, firefighter, retired February 5th, 1989, died May 22nd, 2019. No survivorship benefits. John Taylor, fire captain, retired April 1st, 1993, died May 26, 2019, no survivorship benefits. Leland Wilson, police officer, retired January 7th, 1999, died April 29th, 2019, survivorship benefits to Teresa Wilson, spouse. Have a moment of silence. Okay, thank you. Dick, any of these individuals you worked with?
Actually, and the police officer, except one, I worked with all of them. And there were some characters, and actually, his name is Frank Jost. And I know I would say the same thing if I didn't know him. And I worked with all of them and the best of their families.
Okay,
And thank you for the service.
all right, thank you. Okay, on to committee reports. Note, as we're going through this, last meetings, we really need to get our committees engaged. I know we did have a lot of work with our board retreats that we had, preparing for our joint meeting with city council, so I give us a pass for that. But now I'd like us to get some effort and focus on this again. Let's start with investment committee that does and has been meeting regularly. Chair Griarty.
This will be brief because, you know, we did discuss the asset allocation, and that was quite a robust discussion as it's overflowed here today, still. So that was one item of discussion. The other was we were going to move the IC meetings to every other month. So Trustee Menon, you came just in time. It'll be every other month from now on, starting this August. But we did say that in order to maintain the transparency of what's going on in between the every other month meeting, you know, we would like to have some sort of monthly kind of update via email is fine. I think right now we're doing flash reports and maybe enhance that a little bit with an IC dashboard or something that we will discuss in the August meeting. So I think that's it.
Good. Any other comments, questions about IC? I just want to echo the comments and reiterate, I've probably said this a few times before, I think it's important that as we delegate more authority, responsibility, and reduce the frequency of meetings, that the transparency continues to be the same. And so that communication on a monthly basis, I think, would be one good way to go in that direction. So I appreciate that.
Vince, on that thought, when it comes time to that grand jury report, I really believe when you talked about investments so on, if you talk about when you first got here, where we're at today and the changes that were made can be put in that scenario to the grand jury, I really think it makes a difference because they only see what they see when they're here, don't know how we got there, no matter if the investment was that good or not. We made major changes to get where we're at, and we also continue trying to do.
Yeah.
So to me, it would be, the background, I think, helps.
Good, good. Okay. Audit Risk Committee, Chair
Yeah,
Lanza.
you're making a good point, Vince. You know, I first chaired this, I think, 5 or 6 years ago. I'm chairman again. There were 3 things on the plate: the administration system, thanks, Barbara. The risk, which now I think is fully incorporated at the investment committee and board level, and of course our traditional duty of audit. So if you want to assign something over to the audit committee, I mean, we've got bandwidth now because, you know, knock wood. Thanks, Barbara.
So let me add to that, Trustee Lanza, a couple of things. I just want to, that meeting is usually a joint meeting.
Yep.
Federated does not have quorum for that joint meeting, so we're gonna take the audit committee issues to the actual board meeting that day. So I was just gonna suggest to keep the meeting after with police and fire to have our audit committee right after the Fed board meeting.
Or do we just briefly join the Fed board?
Well,
Is that weird?
no, it's not weird. Matt actually has that same question. Matt,
Yeah.
if you're listening, I was going to ask council because that's a regular Fed board meeting. So I'm used to dealing with joint committee meetings, but I'm not really sure how you actually introduce sometime in the meeting an audit committee from another board to a regular board meeting.
Yeah, there actually are specific provisions in the Brown Act about attending a public meeting of another agency. And I can't quote them to you, but I think you can sit there, but I don't think you can deliberate on
Okay,
it.
so-
So we'll need to look into that. I'll
Yeah.
confirm one way or the other.
However you want to do it, Roberto, whatever you recommend. is
So
fine.
because of that, which is
Yeah.
what I was thinking, but only from experience, I have no knowledge, certainly no legal knowledge. I have a lot of knowledge, but not legal. I figured it was better just to keep up our regular audit committee meeting
Yeah, that's fine.
after the Fed. Okay.
Yeah.
The other thing is we're going to have an item at that meeting, which I'm very excited about. We have a brand new internal audit charter and internal audit plan.
Great.
I'm very impressed, so I think you're going to be really happy
Great.
with it. As you know, we had a senior auditor that we hired 3 years ago, but that position has been used or was used for the about 3 years of the project for the overpayment to members for the
Right.
pensionable earnings project. So
Right.
now we are finally able to kick off what we intended many years ago, which it was an actual internal audit function. So I'm looking forward to it. That's going to be discussed at your meeting as well.
Okay. Governance Committee, Chair
Matt
Votto.
says hi back.
Thank you, Matt.
Governance Committee, Chair Votto is not here. Noticing that it's been almost 10 months since this committee has met. I know that Chair Griarty, when you chaired that committee, Chair Griarty, Trustee Griarty, when you chaired that committee, had put together a work plan.
Yeah.
And I would encourage at that September 5th meeting to have that on the agenda. It had laid out things to be done sort of on a quarterly basis of reviews of policies. And I'm a little fearful that maybe we've fallen behind the curve on a review of that stuff. So if we could make sure that we have an update at their next board meeting on how that is going, I'd appreciate that.
You know who could do that is Tom, because we're hiring him for governance anyway.
Yeah, I just don't want to rely upon the consultant to run the meeting for us. I want
Right.
the chairs to be able to be responsible for
In
that.
coordination with,
Oh.
with Chair
Yep.
Otto.
Disability Committee, Chair Santos.
Thank you. Well, we'll be meeting, of course, Monday, and Drew, our
Yep.
staff, everybody does a great job. Our alternates are always available, and
It's a well-oiled machine.
we have a great panel. Of course, Dr. Chairman is fantastic. And there's going to be some, as always, some come up that's going to be difficult, but very good.
Okay.
Yep.
Good. Speaking of committees that haven't met in a while, Joint Personnel is one of them. I'll rely upon the fact that it's joint, it's not just police and fire, but nonetheless, I intend to move that committee forward with some important projects. I know that Roberto is very interested in us having meetings scheduled on a monthly basis between now and year end to get through a lot of that body of work. So we will have an update for you coming up. Our next meeting is on Tuesday. Proposed agenda items. I actually have one. I'm just going to mention it here. Doesn't need to be started immediately, but it's my understanding that Federated is already going to be doing a bit of work on this, so maybe this time we ride their coattails, and that has to do with Tier 1, Tier 2. We've talked about this for a while. It's got to become a priority now. It's less important for us as opposed to Federated, which has much larger numbers in their Tier 2 plan. But I think it's important that we first start with looking at the actuarial side of things. What are the differences of the two tiers? And looking at it from a membership perspective, those that are active, those are that in pay status, what are the leverage ratios of those plans versus one another? And then we can move from understanding that to moving on to discount rate discussions, asset allocation discussions. It just seems to me that when we talk about how different San Jose is than other systems, within San Jose, we have tiers that are very different, and they should probably be managed in a different manner. We've been talking about this for a while, and I think it needs to move up the priority list. So that will be a proposed future agenda item. I believe Federated has a retreat coming in September, if I'm not mistaken. So maybe this flows on our agenda after they've completed their retreat. It might not end up on our board meeting in September, but maybe in October, we can follow up on some of that work and initially look at that with Chiron. That's one of the items that I have. Any other proposed items? Roberto, anything you feel like we should be covering? that we're not thinking
No,
about?
but I do, as you recall, Trustee Lanza mentioned that Matt said hello, and he just texted me, and I explained to him, Matt, that council will look at whether that's an option to have the audit committee intertwine at some point with the regular board meeting. So once you find out if that's a possibility, I will let the committee know so they can tell whether they should be here earlier or later.
Okay, we'll look into it. The other thing is you can actually notice it as the committee meeting. That might be a way to get around any problems too, so.
Okay,
yeah.
so you just let me
Yeah,
know what
we'll
needs to
look into
happen.
it,
The
yeah.
difference will be either to be here instead of 11:30, 11 o'clock. That's
Yeah.
really the difference.
Yeah, we're easy.
Because we do it at the end of the meeting,
Yeah.
and maybe Matt is listening again, and maybe we can just push it forward earlier, whatever, but we'll cross that bridge when
Yeah,
we
he's
when
still
we
on,
get
just
to
sent me
it.
a check saying we need to go, it's time to go out for a beer.
Yeah, okay, all right, very good.
I have
Not
never,
kidding, actually.
I have never been to a police and fire meeting where Drew didn't say the word beer at least 3
Yeah,
times.
yeah, drink.
There you go.
We're gonna make a drinking game out of it now.
Okay, public comment. I thought Matt would come running down.
So
He just made his comment through the text.
Next.
Cheryl?
So sorry I didn't bring this up during the civil grand jury item, but I am hoping that the city and the boards can coordinate on responses, noting that they will be separate responses, but just so we can be on the same page about who is responding to what, and you know what our responses are, you know what.
I think that's
you know,
very appropriate.
Vice versa.
So,
Okay.
not a problem,
Okay, thank you. Didn't want to not bring that up.
yeah.
Great, thank you.
Go team.
Wow.
Anything else? Okay.
Good meeting.
Meeting adjourned,
But
1:05.
You're back in form.